Okay, we're now recording. We're live, so only say nice things. Okay.
I sure will, no worries. All right, so good afternoon, ladies and gentlemen. Hopefully all of you are doing well today. It is a pleasure to welcome all of you and thank you for applying to this webinar. My name is Bisera and I'm the founder and sales manager of The Scally Learning. As most of you already know, so The Scally is a company that offers corporate trainings with various trainers from all over the world. And it is a great moment for us to have Mr. David Holland here today, as he's one of the most experienced coaches in the world. He has won a series of awards, including Best Client Result Coach of the Year, and having now worked with clients in 37 countries, and also published over 45 books on business and personal development. So also all of you will be receiving a copy of one of his ebooks. So just so you know, we use small webinars, so there will be enough time for all of your questions and discussions and everything you need to know. And today we have a group of 15 coming from Monte Carlo, from Slovenia, Slovakia, Bulgaria, North Macedonia, and Serbia also. So in the name of the Scally team, I would like to welcome all of you to the Financial Masterclass for Business Owners, and I wish you an educational and fun networking experience. So we can start, David.
Fabulous. Bisera, thank you. What a welcome. Yeah, my goodness. When Bisera said one of the most experienced coaches in the world, I think she means the oldest as well. But anyway, I'll take it as experience. There we go. So Bisera, thank you. And everybody welcome. Just a little bit of housekeeping. I tend to speak really fast, and I know I do. If I start to go too fast and it is you're missing some of the words or anything like that, just drop me a note in the chat box and I'll slow down, or I can repeat, and I'm going to go as gently as I can. I'm conscious this is a quite a deep subject to go through. What I thought we'd do, because a financial masterclass can be, if I'm not very careful, can be a little bit of a dry subject if we're not careful. So I'm going to go through some principles with some stories and examples to show you. But any questions you have, type it into the chat box and I'll come back to you and respond. Every sort of 20 minutes, half an hour, I'm going to pause and we can open it up to questions and discussion. I want to make sure we get all the value for you. We're here for 3 hours. So around about halfway point, happy to take a 10-minute break to go and grab a coffee or a comfort break. And my job is just to make sure that you get the best value from the next 3 hours that we're together. So nice and relaxed. Any questions, put it onto chat. We can unmute and have a discussion about it. We're being recorded in a good way. So what you'll get after this is a copy of the recording. You'll get a copy of the slide deck. There's quite a bit of detail on some of the slides, which I don't normally like doing, but given the subject, I think I had to. You get a copy of the slide deck. I'm talking about some templates as I go through. So in addition to the ebook that you're going to receive from Bisera, any of the templates that I'm describing, I'll send them over to Bisera and she can send them out to you as well. You're welcome to use them and take them into your business as we go along. So that's how we're going to run it. Is everybody okay with that? Just give me a nod or a thumbs up or something. Excellent. Peter, you are my favorite person because you put your thumb up straight away, which is excellent. So real quick intro, who are we? My name is Dave Holland, as Bisera mentioned. I'm sat here on that little blue pin, just northeast of Metz in France, right on the German border. We have a renovation cottage and we're working from home because of the lockdown, as we all had to, I guess. So this is where I'm based right now. We have offices in Luxembourg, just up the road a little bit there. That's where our head office is based. And we have offices over in the UK in Swindon as well. As Bisera said, we work with clients all over the world. In I think it's 37 countries now, and here's sort of just the flags of the people that we deal with, and I've been fortunate to visit many of the territories we're working as well. And my role is I'm a business coach and trainer and business investor. So first thing, just to let you know, I'm not an accountant. I'm going to approach the business numbers and financials from the perspective of a business owner, entrepreneur, manager level. So if you have any questions around the accounting rules and regulations, We can find out for you. I may not know all the answers to that. So my official guidance would be, if you have any questions regarding the structure of the accounts and the statutory accounts, what you can and can't do, please refer to your local accountant. They are much more highly qualified than me, if you like, in that area. But I'm going to go through the principles of business numbers and financials and ratios that I find work well with my clients in their businesses all over the world, and work in my businesses as well, and with my history. So I'm not an accountant, but this is really to help you in terms of your management and leadership and entrepreneurial journey. So there are three, to kick off, there are three documents that we're going to be talking about. And the first one is the income statement, profit and loss account. This is a critical document for us in business. I'm going to be talking about the numbers and the accounts in terms of accrual accounting, not cash accounting. So what we're going to be talking about is the numbers we're going to be discussing are the numbers that are reflected at the time of the transaction, not when the money is transacted through the account. So what I mean by that is when we raise an invoice, that's when we take the sale. So where we don't take the sale when the cash comes in, that's cash accounting. There's a method for that, but I'm going to be talking about things based on transactions, not just the cash being received. So profit and loss account, cash flow statement, and the balance sheet. Those are the three main documents we want to really work with. The number one document for us is going to be the profit and loss account. P&L is what we normally work with, management and leadership basis. I'm also going to be talking about things that don't appear on the accounts. There are some numbers and ratios and measures that I think are really important that don't appear on these documents, but this is the basis for us. So I'm also going to assume that you know nothing about accounting. And what I mean by that, I'm going to go really basic and explain some basic principles. If you already know, then that's great. It may be a refresher for you. Other people may be new to it. I'm going to go from the basics and start through. So number one is the profit and loss account. This is the structure of a basic profit and loss account. We have sales at the top, then we have cost of sales. That generates a gross profit figure for us, and I'll explain in a second. Then we have overheads or indirect costs and net profit. This is the basic fundamental template that we all need in business, whatever size of company organization we've got. So how it works, you would have sales of 10,000. This could be in a week or a month or a quarter or over a year. Sales of 10,000 euros, $10,000. Cost of sales, 6,000. Now, cost of sales are those costs that are directly attributable to the generation of the sale. So that will be things like materials, direct labor. It could be transport in certain companies. In my business, for me, for example, when I deliver a program like this, I am a direct cost. I'm a cost of the sale. So we have a sales figure and the cost of sale, and then cost of sales, deduct it from the sales figure, gives us a gross profit. Gross margin, if you like, same thing, doesn't make any difference, it's gross profit. And then we have overheads. Overheads is everything else in the business: administration, office, power, heat, light, rent, rates, insurances, administration staff, everything else in the business that we don't directly associate or attribute to the delivery of the product is called an overhead. And then we have net profit at the bottom. So gross profit minus overheads equals net profit. And that is fundamentally the basis of measuring the performance of, in my experience, sort of 90%, 95% of most business operations out there. And this is something for you to have in your business. If you don't have a regular P&L or management accounts or something like that, I recommend that you do. I would go for monthly set of accounts so you can keep track of your business and where it's going to be going to as well. Speak to your accountant. They can generate this through whether on Outlook or Xero or Sage, whatever it is, automatic generation. This is a real key barometer for management. Now you may come across where we have gross profit percentage or gross margin. So this is just a percentage. It's gross profit expressed as a percentage of the sales figure. So this business here sold 10,000, made 4,000 gross profit, 40% GP. You may hear it called contribution. You may hear it called gross profit. It's the same thing. So I was going to let somebody in. Here we go. It's the same thing. So GP margin is the percentage, and gross profit is the number. It's the same thing as contribution. So that's where the gross profit comes from. And then net profit is the bottom figure, and that is expressed as a percentage of the sales figure as well. So it's 10%. So 1,000 net profit out of 10,000 sales, 10% net profit. Net profit, or you can call it contribution as well. So that's the basic structure around the profit and loss account. And we're going to go through all those numbers in a bit more detail, tell you how they're important, what you can do with them, how you can use them to manage your business. But that's just the first sort of template to look at. Then we have the balance sheet. Now, the balance sheet is really it's a financial statement of the business, a snapshot of where the business is in terms of basically three things. And it's what do we own? What assets do we have in the business? It could be machinery and plant and equipment, or cash, for example, it'd be assets of the business. On the other side of the balance sheet, we have what do we owe? Do we have any loans we've got to pay out? What are we owing to other people, trade creditors and debtors, this sort of thing? What do we owe? And the third thing, to make it balance, is owner's equity. So if you own the business, as I own this company with my wife, Lynn, of 35 years next week, as we just discussed earlier on, owner's equity. So if you're owning your own business, there are two things you're really interested in. One is going to be likely the profitability, net profitability of the business, because that's where you derive your dividends from after profit, after tax as well. If you're really interested in net profitability, that's where you take your income, your drawings from. And also you're going to be interested in owner's equity, shareholder value, if you like. If you don't own the company, you're very likely to be getting pressure from shareholders, because what they will want is dividends, and they want their equity to be increasing. So the balance sheet is a list of everything we own, what we owe, and the difference between the two is owner's equity. So that's what it looks like. Total assets is the same as or equal total liabilities and owner's equity. So, and it balances because those two figures always add up the same. What it means is that where there's a fluctuation of assets and liabilities, the difference is made up by the owners. Either they have to put money in to support the business, or they can take money out to reduce their equity holding. But the balance sheet is a critical document, not so much from a management point of view, but if you do own the business, it's very good to have this. Certainly, I would want a quarterly balance sheet. We get monthly accounts in my businesses, monthly P&L, management accounts, and quarterly balance sheet. We don't worry about it on a regular basis. Quarterly is fine for us. It depends on what business you're in. And the final one then is cash flow. So we're going to look at cash flow forecasting during the next couple of hours. The difference here really is, just remember, we're looking at accounts, management accounts, statutory accounts, and the P&L. That doesn't measure money. It doesn't measure cash, because we're on accrual accounting. So the fact you see a sales figure on the P&L, 10,000, what it means is you've raised an invoice, doesn't mean you've been paid for it. So then we have debtors and things we'll look at separately that goes onto the balance sheet. But cash flow is really critical, because this cash flow, as opposed to your accrual accounting, is a measure of your movement of money, physical money, into and out of your bank account. No business, in my experience, ever goes bankrupt or falls over because of lack of sales or lack of margin or lack of customers. The only thing that kills a business is lack of money. They run out of cash, because you can put more money into a business to keep it going. If you get stuck, you can do. So cash flow is really important. When we talk about, and we'll come on to this later on, forecasting and budgeting, I do a budget, 12-month budget for our businesses, and we have that approved by my board. But also we do a cash flow forecast to go with it. So a profit and loss account forecast or a budget, and then we compare our accounts to that budget we set. But we're very, very keen we have a cash flow forecast as well. And cash flow is dependent upon creditors and debtors, or loans and statements and things coming through, what we're going to spend and where we're going to spend it. Make sure you've got control over your cash. It's different to the P&L, but it's equally important, because money is what holds a company together. So is everybody okay with that? Does that make sense? Everybody happy with that so far? Excellent. Okay. Now, what I thought I'd do is to sort of run through the financials, if you like, rather than talk about your balance sheets and management accounts in detail, I've chosen 26 principles or numbers that I think it's really important that we understand. And these are numbers I work through in my own business and with my clients as well. Now, 26 sounds like a lot. Some of these may apply to you in your business and some of them may not, but it's really just going through these principles, how you measure them, what you can do with them. Some are on the accounts and some are off the accounts. There's 26 principles I'm going to run through with you, and we sort of count our way down as we go along. Any questions, please just type them in. So the first one, and these are in no particular order or sequence of priority, they're not more important than the others. They just sort of flow through from a conversation point of view. So the first one is conversion rates. And this is a marketing or sales conversion rate. This doesn't appear on your accounts particularly, but as a financial driver of the business, really, really important in my experience. What this means is it's how many quotations do you do, or presentations, or how many inquiries do you get? And based on that, how many clients or orders or customers or students, whatever it is in your business, do you win? Because this is a key driver of the efficiency of your marketing. So for example, if you do 50, you get 50 client orders coming in a week or a month or a quarter, 50 bookings, 50 confirmations of events or whatever it is in your business. If it's taken you 100 quotations to get them, you do 100 quotations and you win 50, then your conversion rate is 50%. And this is, in my experience, when I talk to people, and I can ask anybody on the meeting here, if you like, what do you think your conversion rate is? Two things normally happen. Normally, first of all, people tend not to measure it. They don't measure their conversion rate. Therefore, they guess their conversion rate. And what happens is they go, yeah, we're pretty good. We're pretty good at sales and conversion and marketing. And if they don't measure it, they normally guess at around about 80%. 8 out of 10. And my first question to them then is, okay, well, look, let's measure it. Let's measure that and see what it really looks like. Normally what happens when we really go through it and we look at all the quotations or presentations or whatever it is that you do to sort of convert your clients, it's a lot lower than you think. Normally, I've worked with a client yesterday and they're in professional services in the financial services sector. And I said to them, well, what's your conversion rate? They didn't know. We measured it. It came out at, I think it was about 30% it came out at. So it's lower than you think. But what it means is if you want to, if your conversion rate is 30% or 25%, whatever it is, doesn't matter. How do you double your business? Well, you don't do it by more marketing. You do it by increasing that conversion rate. If you take your 25% conversion, whatever it is, and you can double it, you're going to double your business overnight. No more marketing expenditure, no more resources required in marketing or advertising. You're just going to convert. And this is the sales technique. So it's a great one to measure. My conversion rate is running at, just so you know, I'm going to measure it, at 92.4%. Now, what it means is, in terms of how do you get your conversion rate up, and this is maybe a subject of almost like a separate workshop, to be fair, but the trick is only work with people or only sell to people or only invite people to work with you that you know you want to work with. So people who contact us, we've got a very clever marketing system. If they get through to speak to me, they've already bought, and then pretty much they've already bought, and we go away and do a deal and do a great product for them. But look at your conversion rate, leads, inquiries, and this can be on the website, it could be through social media, it could be email inquiries, whatever it is, however you measure it, how many inquiries you're getting in and how many clients or how much you're winning, and measure conversion rate, key driver of marketing performance. So that's number one. Number two is sales efficiency. And this is aligned with conversion rate. So we have a client up in Aberdeen, and they are in the machine tool business. And they said their conversion rate was very, very high. Very good. It wasn't. It was around about 50%, if you like. But what we found was that they had a big range of products. They were selling little machines or tools and equipment, all the way through to big machines. These things could be, £250,000 each. So big mix of range of services and products that they were putting through. So what we looked at there, this is the sort of sales efficiency or conversion efficiency, is the average order value compared to the value of the inquiries. So if the average order value that you're getting is €500 or pounds or 500,000, whatever it is, but the average value of the inquiries that you're getting are higher, then you're only winning 50% of the value. What it means is basically you're winning all the small jobs and not all the big jobs. And what we found for the guys up in Aberdeen was they were winning a lot of business. The conversion rate went up, but they were missing out on the small orders. They're getting the big ones, not the small ones. And what we also found then was that in their business, that the margin was higher on the smaller orders than it was on the big ones. So we had to look at that. So we wanted to get the conversion rate was high in the end, about 80%, which was great, really good. But the mix, we had to look at the mix as well. So conversion rate can be a bit of a blunt instrument, blunt tool if we're not careful. So get the conversion rate up, but also look at the average value of orders received compared to inquiries, if that applies in your business. For these numbers here, sort of 50%, it's an efficiency drive. We really want the average order value to match the average inquiry value. Likely, we want to have a good mix. We're about to win all sorts of business. What we found is in a number of businesses is we win the big orders and the little ones come in. We need those as well because they fill the gaps between the big ones and the margins can be higher. So don't just win the little ones. They can be a lot of administration. Don't just win the big ones because they can be tight margin and there's gaps in between them. You'll likely want to mix. So just check on the average value of inquiries and compared to orders as well. Any questions so far? Please just again just type them in. I'm going to launch because there's a lot to go through. Any questions? Is it making sense so far? Everybody happy so far? Just yeah, everybody's still here, which is good. Excellent. And now the acid test, if you like, of marketing now, marketing and sales, is the acquisition cost. What's it costing us to buy a client, buy a customer? So this is basically the cost of sales and marketing divided by the number of clients equals the price per client. So if you're spending $1,000 a month on marketing, and it might be you're doing SEO, you're doing AdWords, you've got a marketing department or whatever it is, you're investing in marketing activity. It could be advertising or anything like that as well. And you've got a sales team. This includes your sales team, that people are actually, responding and speaking to your prospects as well. €1,000, pounds, dollars, whatever you're spending, that gets you 10 clients. Well, great. Then the price per client or the cost per client is 100. Now, the challenge with this, and the reason that I put this up here, because these costs don't appear in your direct costs, because this is an overhead. Sales and marketing tends to be an overhead costs, and it gets lost in the mix somewhere. And I've come across a couple of times where we looked at the marketing and acquisition costs, and it was in the order of thousands of pounds, thousands of dollars to buy a new client. And when we looked at it, the profitability of each client wasn't being met. So the gross margin looked good. They were getting business, but the cost of acquisition was so high, they were losing money at the bottom end of the business as well. So in my business, for example, the acquisition cost for me, it's around about €250 per new client. So for me, retention is very important. And if you get the first order and you want subsequent orders, then you're into customer service as well. So acquisition cost could be based over the lifetime value of the client as well. But it's an interesting one to look at. What's it costing you to buy your next client? Now, when you speak with marketing people, and I am a marketing person, we do marketing, but they will talk about things like visibility and awareness and number of clicks or bounce rates and this sort of thing, which is all very good. But when we're looking at client and acquisition costs, we as business owner entrepreneurs, I want to spend, £250, euros, and I want to get a client back. And that client's going to be worth more than 250, basically. Otherwise, I'm out of business. So the understanding the acquisition cost enables us to say to our marketing team, look, we're going to give you a 5,000 budget or a 10,000 budget. But from that, we expect to get X amount of clients, because we know what our conversion rate is from the inquiries we're going to get and the average value they're going to spend with us, and we can set some real hard parameters, some forecasts and budgets and targets for our marketing team. Is there anybody in marketing on the workshop today? Anybody in the marketing business or not? Dejan, you are okay. So I'm not picking on you, okay? I love marketing people, all right? But what happens?
I'm not in the marketing. Well, I run the marketing for our.
Oh, good. Okay. Well, you can use this as a stick So beat them with, there we go. But one of the things, because marketing people, they tend not to like, in just in my experience, this tangibility. I'm going to give you $5,000, pounds. What do I get back? And if they start talking about visibility and awareness and all those and clicks and likes, and that, I'm really not that interested in it. For me, marketing and sales should and must generate leads and inquiries, and it's got to generate clients as well based on my conversion rate. So when you're looking at this, you can measure it, and then you can set a budget and a forecast, and not as a stick to beat people with, but it's a very good barometer to say we're getting value for money out of our marketing and our sales approach as well. So acquisition cost is a key one. Another one that doesn't appear in the accounts so much, but another key one in my experience is what I call attrition rate. So this is lost clients over total clients. So for example, we work with a number of martial artists over in the UK and internationally as well. And they have a number of students doing Krav Maga or Kung Fu or karate or whatever it is, and they have what is called an attrition rate. They lose a number of students each month. So how that would look, for example, if we had 25 clients and we lose, we've lost 25 students and we've got a total of 250. Well, in percentage terms, that's 10% attrition rate. So quick look. So what else are sales costs are there? So a quick question here regarding the cost. So I'm just going to go back to reflect on this. You can see on the chat, sales costs. So sales costs would be anything like, maybe you go to an exhibition, you do a conference, you go traveling, you have to go meet people, you have salaries of your salespeople, maybe you have to produce samples or brochures or whatever it is. That's a sales cost, the cost of the people associated with selling. Marketing would be the similar sort of thing, but would be cost of your website, your social media, your AdWords, your pay-per-click, the visibility you generate on maybe social media, maybe you're doing emails, maybe you're doing telemarketing, maybe you've got a team of people making cold calls out. The cost of those people is a cost of sale. It's a sales cost that should go into the acquisition cost. The cost of sales, raw materials to make goods for sale. Yes, sales factory workers making the goods and posted finished goods. Yes, absolutely. Yeah, good point. This comes back to the costs that are associated with the production of the good that you're selling. So, for example, where it gets a bit sort of complex, if you like, is if you're a transport company, and I used to run a transport company, I had a fleet of vans. So the cost of the vans and the drivers was a direct cost, a cost of sale in my company. Now, if I'm a manufacturing business, maybe I charge extra for transport, so those costs are indirect, maybe. But it's really anything that's associated with the delivery or the production of the service or the product that you're selling for. Basically, if you don't sell products, you don't get those costs. That's the acid test for it as we go along. But good question. So I hope that answers those. So back to the yes, they are. Yes, salaries. Yeah, that's a great point. Don't get confused with, at least from a management accounting perspective, if you have weekly paid people in a factory, or you've got salaried people in an office, they can both still be direct costs. Depends what the business is. If you're doing design work, for example, or consulting work, salaried people can still be a direct cost of the product or the good. If you're in the accounting or consulting world, for example, salaried people are a direct cost. Yeah. So back to the martial artists. So this martial arts business has got 250 students, and every month, because we measure it monthly, they lose 25 students. So just to stand still, they've got to bring in 25 more students to come in. Now, one of the key drivers I find in the martial arts business, but may apply in principle to your businesses as well, it's one thing winning a client and getting the customer, but it's keeping them as well. That attrition rate or retention rate, if you like, is the opposite to it, is a key driver, because if companies that are very good at sales and marketing but don't keep their clients have huge overheads in terms of extra spend on marketing and sales and all this sort of thing. If the customer service is not good, you have to, refunds, and you have to go, it's a mess. So watch out for your attrition rate. In the UK, for example, the average attrition rate of a martial arts academy, just so you know, is running at 9%. So they've got to rebuild their business. Every 12 months, they lose all their students. 8%, 8, 12s, 94, that's what it runs very, very high. So we'd want to get that down. So what I focus on with them is how to build their business is, let's get the attrition rate sorted out first, hold on to what we've got, and then we look at the conversion rate. And just by doing those two things, we'll transform their business. So we've got martial arts academies now with an attrition rate of around about 1.5 to 2%, which they keep in all their clients. And then when it comes down to bringing new students on board, we get their conversion rate. We aim for 80%, which means it's very, very efficient in terms of sales and marketing, but also very efficient in terms of customer service and retention and lifetime value of their students as well. But and for you, what is it now in terms of what I do? My attrition rate. We looked at this from a coaching point of view, and it turns out, just out of interest, that the business coaching, they tend to hold their clients for around about 3 months. That's how long a coach will work with their clients for, which means they've got to get a lot of clients on board. And I was told this by another coach in Luxembourg. Doesn't matter who it is. I thought, crikey, we've got clients who've been with us for 15 years. They stay with us, and we're with them through ups and downs and sideways and growth. So we have clients that stay with us. On average, it's around about 5 years that our coaching clients stay with us, which is better for us from a point of view of retention and longevity. But look at your attrition rate. It's a key driver of cost as well. So again, another one, number 5. This is off the account system again, but it's an interesting one. This template, by the way, is one of the ones I will send over to you. You're welcome to have this. It's a simple one to fill in. It's order intake. Now, this doesn't apply to every business. If you're in retail, for example, or martial arts, you don't get orders, you just get people showing up in the B2C, business to consumer type sector. If you're in the B2B sector, when you're delivering on orders or bookings or products and services, you may get an order first before you deliver the products and services. So we, for example, have a conference we've been booked to go and do next March. It's a 2-day conference up in Luxembourg, and that the order's in, so it's booked, we're confirmed. So I measure the amount of orders we receive. Now, the reason for this is why it's so important in my experience is the accounts, when you get your monthly accounts or quarterly or your balance sheet or whatever it is, that's always looking back in time. It tells you what happened last month, last quarter, last year. Whereas order intake is a forward predictor. It's a predictive number. So all you do, and I'll just go and show on the screen, is when you get the template, it's self-explanatory. You put on here your annual sales target into this red box. What's that? $1 million, let's say. And this says, okay, well, your weekly target of orders to come in to hit that $1 million is 19,231. So every week we've got to get 19,231 of orders coming into the business. And all you do is fill in the spreadsheet as you go along, and it plots it for you. Are you on track? Are we behind? What's the future order book look like? Are we safe? Are we secure? Do we need to jack our marketing up? Where's the gap going to be in the future? It gives us a forward picture of the business. Now, that may or may not work in your business. I don't know. If you're in the B2B sector and you're taking bookings and reservations and orders, then it does work. If you're in the B2C sector, then maybe not so much. But the daily order intake is a great KPI. So we maintain this spreadsheet so I can see what our sales will be through to, we're up to next June now in my business. That's not all the sales we're going to get, but it's showing me what orders are in. Once it starts to drop below, I like to have, just so you know, in my business, in the speaking and training workshop conference business, I like to have at least 50,000 revenue of orders ahead of us. So pre-booked orders ahead. If it drops below 50,000, we start to do our marketing. We start to talk to people and place bookings. But because we're working 6-9 months ahead, it gives us time. I've got time now to go and do work in February, March, April next year. I've got time to go and do the marketing and visibility for it. If I get a set of accounts and it tells me You didn't make sales last month. Well, I can't fix that. It's too late. It's rear view mirror. So I like this particular approach because it's forward thinking, it's predictive, and it gives us a view of the future as well before it's hit the accounts. But again, I'll send the spreadsheet over. Very, very straightforward. You're welcome to use it and circulate it. And if that helps, then please build it into your routines. Okay, number 6, again, now getting towards the accounts now. This is just something I find that it confused me for a long time, and I find it confuses lots of people as well. So first of all, the accounts that you get, management accounts or statutory accounts, whatever they are, will measure your margin. They measure profitability, measure margin, and we're going to touch on that later on. But when you do pricing, if you're buying products and selling them on to people, likely you're doing a markup, certainly in retail or any products when we do it with machine tools as well. And I had a conversation with a client over in Germany where I went to see them. It doesn't matter who they are, obviously, for obvious reasons, but they were making architectural fittings and ironmongery. And I went to see them as a father and son in the business, quite a sizable company. And they contacted me on LinkedIn and go, can we go and just look at their business? They were really struggling. And when I got there to see them, lovely guys, and they showed me their accounts. And they said, look, when we price our products, we double everything. We double up, we buy a product for 100, we double it and sell it. And that's 100% margin. And it clicked with me then. Okay. He said, but when we get our accounts, that's never reflected in our accounts. And it's like, well, it's not going to be, is it? Because markup is one thing and margin is something else. So again, if you've gone through this before, my apologies, but it's a real interesting one. Watch out for this in terms of pricing. So this is how it works. Cost price of $1,000. You buy this thing for $1,000, £1,000, €1,000, whatever it is. And then from a pricing strategy point of view, you're going to mark up by 50%. So we're going to sell that thing for 1,500, 1,500, mark up by 50%, sales price 1,500. Now, when that appears in your accounts, it's not going to show markup, it's going to show margin. Now, the margin on that sale price is 1,500, of which you're making 500. So the margin is 33%. Is everybody okay with that? Because that's sort of yeah. So watch out. What it says in your profit and loss accounts will be margin, but it's different to how you price it. Now, the bigger the markup, the more obvious it is, because let's say that the markup is 100%, like it was for these guys over in Germany. Then you double the cost price, you double it 50. You're making 100% markup. 100% markup is 50% margin, because it's the profit expressed as a percentage of the price. Margin is the profit expressed as a percentage of your costs. Markup is the profit expressed as a percentage of your sale price. Now, as it comes down, let's say you add on 10%, you mark up by 10%, but then the margin is going to be about 9%. I rough cut, I'm doing it in my head here. So the lower your margin, the lower the markup, the closer it becomes to your markup. Difficult to spot it at low margins. So if you're in a low margin business and you're pricing on markup, just watch out, it can trip you up. So you just want to be careful that everybody understand the people are pricing your goods and services. So what we did with this company over in Germany, we just we changed the pricing strategy and so reflected the accounts, and then we managed to get the pricing up a bit. They were winning lots of work. They were winning loads of work because they were too cheap, because they thought they were doubling their 100% margin. You can't have 100% margin. So we adjusted their pricing strategy, put the prices out there, looked at the conversion rate. Conversion rate dropped a little bit because we put the prices up, but we sacrificed conversion for margin, and we got the margins back on track. And within about 2 or 3 months, they were literally, well, they weren't making any money before, but they started making money. And this is one of the things to look at. The joy of what I do is I can look at a business from the outside, and it's very easy to pick holes in it. And I mean in a positive way, but sometimes all I find is that people within their businesses, they know this stuff. They know the difference between markup and margin. And I guess most of you guys do as well. Absolutely. But because you're so close to it, you miss it. It just becomes the way things are done. Oh, sorry. Yes. I think I'll let somebody in. Yes, I think. Oh, my apologies. Yes. Well spotted. Thank you, Philip, for the nudge. Yeah, it's on my other screen over here. So, well, yeah, just nudge me. I'll absolutely let them in. Well spotted. Welcome back. Welcome back. Okay. So markup and margin, be clear on what it is. Markup is the profit expressed as a percentage of your cost price. Margin is your profit expressed as a percentage of your sale price. And it's the margin that is reflected on your P&L or your statements as you come through. Just be careful you don't confuse the two, that's all. So it trips a lot of people up. Okay, number 7. Now we're getting into the accounts, if you like. But this sounds, an obvious one. Everybody knows what a sale is. It's when you raise an invoice. However, what I would urge you to do is, obviously it's a sales figure for the month or the week, whatever it is. But I went to see two women running a company over in the UK some years ago now, an events company. And I sat down with they're called Jane and Helen. You don't know them; they're quite safe. And I sat with Jane, and we're talking about the business, this sort of thing. And she said, "Look, we are in trouble. We don't know why. We're in trouble. We are at our overdraft limit. Where credit cards are maxed out, and we're really busy, but there's no cash, no money. We're really struggling. What do you think?" And I said, the first question to her was, okay, well, what are sales doing? What's the invoice figure for last quarter? And she looked around, to Helen, who was sat over here on another day. Oh, Helen, what was our, what did we invoice last quarter? And Helen looked back at Jane and just said, "Oh, I thought you were doing that." So they were really busy in the business, and they'd been going for 3 months. They hadn't raised an invoice because Jane thought Helen was doing it and Helen thought Jane was doing it. And when we sort of talk about this, we go, "I see, that's crazy. That's ridiculous. That's insane. Of course you're invoicing." But I guarantee either you're not invoicing or you're not invoicing all that you should. And even if the invoices are being raised, I'd urge you to have a look at all the work that you do or the products that you dispatch or the services you offer, and just make sure you're invoicing everything you should, because accountants are classic with this. I have a couple of accountants who are clients over in the UK, and they told me they were really good at this. They were really good. They were invoicing everything. And they weren't, because they weren't recording things. They were giving away advice and guidance and support to their clients, and they weren't charging for it. And therefore their margins dropped, and they were sort of struggling a little bit. So it sounds obvious, but just as a little bit of maybe housekeeping in your company, in your business, is be aware you may be missing things as you go along. So invoice everything. It may be one of the ways around to make sure you do invoice. Something that we do, for example, is we allocate job numbers. So Lynn, who's my boss, my wife, we allocate a job number system, and every booking we get is allocated a file, and then we cross-reference the order file with the invoice file, and we match them up together, and then we just look for gaps. And if there's no gaps, everything's invoiced, away we go. It's really easy to miss. I guarantee if you look through your sales ledger, I guarantee you can find things that have been missed. You just can. And of course, that is just pure profit down to the bottom line for everybody. So I recommend it. So sales, yes, but it's an invoice. Now, because we're on accrual accounting, not cash accounting, a sale is the point at which the invoice is raised, the timing of it. So if I raise an invoice in October, then that's the sale taken in October. I may not get paid for it for 30, 60, 90 days. That's cash flow. It's separate, because we're looking at accrual accounting. So make sure your invoices are raised on time. Make sure your invoices state your payment terms as well. The number of invoices I see, and I receive invoices from people as well from time to time, and we always pay them. We always play nice. We play them. But if it comes to it, here's an invoice for whatever it was, marketing services or whatever it is, and it's for the X amount, and here's your invoice dated for July. Well, when do you want us to pay it? When would you like us to pay you? And they go, well, now, immediately. Now, if you want payment immediately from your clients, you've got to tell them. You've got to be contractually bound to them. It's got to be on the invoice as well. When's the invoice due? Because when we come through to cash, and we're going to look at debtors later on, if I get an invoice or I don't get an invoice, if I don't get an invoice, I'm not going to pay you. In fact, I can only pay people when they send me an invoice. And I've got a number of suppliers who said, "Oh, look, we haven't got around to the invoice yet. Can you pay us anyway?" Well, no, I can't. I mean, I could, but it's going to get messy, and we're not really allowed to do that. raise an invoice, get it to me, I'll pay it, but tell me when you want to be paid as well. What are your payment terms? Make sure that's really clear on the invoice as you go along as well. So invoicing equals sales. Make sure you invoice everything. It sounds ridiculous, but I can guarantee if I looked at your sales ledger, there might be some gaps in there, which is a good thing because you can go and catch up and have a qualified system for it. Have your an accounting system that does this. It's not my field, as you know. We use QuickBooks, Xero, Sage, whatever, but get a good accounting system and get somebody to look after it for you. Even though our company, there's only 5 of us in our company, we're not very big. I'm really clear we have identified job roles, and one of Lynn's job roles is invoicing and operations, and she's very, very good at it. But have somebody who's got responsibility for generating the invoices and make sure they do it on time and make sure they get it done accurately as well. Otherwise, you're giving money away. I see it a lot. That's why I see it a lot. Not mentioning no names of companies, but big companies as well. You know, we work with a lot of companies in Luxembourg, the big banks and fund and asset managers, this type of thing. You'd be amazed. You'd be amazed the number of people who haven't raised invoices, and then they want to go back 3 years and raise an invoice on a customer for something that was delivered 3 years ago. Well, you know, good luck with that. It's not going to work out well. So make sure you invoice everything. Very simple, but there we go. Okay, I'm just going to check in anybody and nobody else coming through. We're okay. Now, the next one is direct costs. This comes back to the question we had earlier on. So back onto them, so the accounts. Now we have a sales figure. Then we have direct cost. Now, what is included in a direct cost? Well, it depends on your business. It may be that there are people involved. People, if you've got a factory or manufacturing things, then it's the people who are manufacturing the products for you. If you've got people who are delivering training or consulting or delivering professional services, it's them. They would appear as a direct cost. Now, something to watch out for, this is where it gets a bit complicated. I recommend, my official advice would be speak to your accountant about this, of how you structure it. So for example, if I've got a factory, a manufacturing plant, and I've got the wages of the people working in that factory, do all their wages go to direct costs? What about things like holiday pay or sick pay? What about the taxes, the employment taxes? And the answer is, it's whatever you choose, basically, but you be consistent with it. You can put into direct costs whatever you like, but we want to be consistent with it. When I was running a manufacturing plant, for example, I would have people's wages in there, but if they were sick or on holiday or doing something else that was not associated with the work, that time, that cost was taken away and put into overheads. I only reflected the physical time that they're working as a cost of production. Because if they're sick, they're not producing, therefore it would make the factory look inefficient. So be really clear what's in your direct costs and what's coming out of it. It doesn't matter what you do with it, almost, because these management accounts we're talking about, you can do whatever you like, but be really consistent with it, because direct costs, as we'll see in a second or two, is what dictates our gross margin. So we want to be really clear what's a direct cost. So it'd be labor, it could be materials, it could be the components, it could be lumps of wood or pieces of metal or ceramics, whatever it is. If it's sort of a manufacturing point of view, then you've got all your materials here as well. Now, if you're looking at materials as a cost of sale, a direct cost, what do you do with wastage? Where does that go? Do you charge wastage of, offcuts and waste or things that go wrong? Do you charge that to your direct cost? Or does that go as an overhead? And it's a choice you can make. But again, these are discussions I recommend you have with your accountant or your production people, whatever it is, and just agree what the parameters are. And then when you agree, run it for the year for consistency's point of view. What it means is that, for example, if somebody's on the shop floor producing and then they are doing something else for you in the factory that's not producing, they've got to record it on a timesheet. You need to record the time. So accountants do this a lot. Within the accounting world, people have a timesheet. They will book their time. They book client work and they book training time or research time or whatever it is they're doing, but they can't book training time to a client. Therefore, that's not a direct cost. Training time is an overhead. They forecast it, they budget for it, but that goes into overheads. Only the work associated with clients goes into direct costs, which generates a margin. And it depends what business you're in. You can choose. You can be flexible about it, but be clear, be sure you know what you're assuming is a direct cost of materials and labor. It's basically those two. Now, a lot of companies run, for example, if you're in the professional services, they just have a sales figure and everything's in overheads. In my experience, that's dangerous, because we should have a measure of productivity and efficiency. Everything's just lumped into overheads. It's not very elegant, and it doesn't give us many management tools. Look at the management tools here. So we want to manage the direct costs. So how direct costs and sales drives our gross profit. So gross profit is simply the sales figure minus the direct costs, gives us our gross profit. Very simple, very straightforward, but that's why we've got to be really careful with what we choose to put into our direct costs. So let's say, for example, you've got somebody on the shop floor in a production unit, or an accountant. Let's say they cost us 25,000 a year, but we're only putting in 15,000 of their costs against sales. We must have the balance, that other 15,000, the 10,000, so 15,000 direct costs. That other 15,000 has got to be taken somewhere in the accounts. It's got to be in there somewhere. What I have found, and a number of people have got, I'll pick on the accountants again. Accountants are weird. They should be brilliant at this, but sometimes they're not. And they will say, well, we've got an accountant, we pay them 25,000, whatever it is. And we only know they're going to work half their time on client work. So 12,500 is direct cost. Where's the rest of it? Oh, well, we're not really sure. It doesn't appear in the accounts anywhere. It'll appear in the P&L you get at the end of the month, but it's not in their management accounts or their budget or their forecast. They forget. So be really sure that you've got direct costs apportioned to activity, and the balance of it, the rest of it, has got to appear in overhead somewhere. So this is how it works. So sales, 10,000 sales, and you've got 4,000 of direct costs. So your gross profit is 6,000. Easy. That's how your accounts are going to be structured. So from a management point of view, I think that your gross profit is one of the key drivers of success in any business at all, because it's performance, it's productivity, it's output, it's showing us that we are able to produce the product and the service in an efficient way. And from a business owner perspective, it's a real key driver, because that's what contributes then towards our overheads. So gross profits, key driver, should be a KPI, key performance indicator, in every business. What I have in terms of, in our business, we have a gross profit target per month, and I'm going to touch on break even later on, but we know exactly what figure we want to achieve each month, gross profit wise, and we know a date we want to achieve it by. So we have a gross figure, gross profit target, and a date in the month we want to hit it by. I had an email come through from a client. They're in the relocations business, and we have the same numbers for them. And they emailed me last month on the 7th of the month, I think it was 6th or 7th of the month. And they said, we've just hit our gross profit target for the month. Wow. So they've hit the gross profit target for the month. But on the first week, which means they've got 3 weeks now of overachieving profitability, which is great. But you've got to have a target out there, a gross profit target in your business. So sales minus direct costs, whatever you choose to be direct costs. Now, direct costs may be termed cost of goods sold, COGS, same thing. It's the cost of the goods that are being used to generate the sale. Direct cost of goods sold, same thing, but gross profit, a key driver. Then we have gross margin. Now, this is different to gross profit, because it's a percentage. It's all it is. You have gross profit, then you have gross margin. And this is something to look at. This is an efficiency measure, because month by month, your gross profit in currency or in cash or money can change. You have a very busy month, then you're going to make a lot of gross profit. If you have a quieter month, you'll make less gross profit because the sales are down. But what you're really looking at is are the sales down, and is our efficiency down as well? So gross profit is simply, or margin is simply gross profit, 6,000 profit divided by sales of 10,000, multiplied by 100% gives us 60%. So gross margin is a percentage, and I want to know both. I want to know both. Even if your gross margin or gross profit is up for the month, that's great. Congratulations, celebrate. But are you holding gross margin? Because what can happen, let's say, I've seen this happen before, and you may be doing this as well, I don't know, is you discount heavily on a product or a service or a product, whatever it is, you're discounting, you get the sales in, and actually the gross profit looks good because you've got a big jump in sales and the gross profit looks okay. But in percentage terms, it dive bombs, it crashes and burns for you because you're discounting to get the sale. And so you get the monetary value is okay, but the percentage drops, and then you've got to come back and balance it again. So I recommend you have both. From a management point of view, I want to know the gross profit each month, maybe even each week for some clients. And I want to know the gross margin percentage as well. It's a key driver. Okay, any questions so far? It's making sense? Just checking everybody's still with us. We're going to go, we'll have a Q&A thing in a second or two. Excellent. Thank you. So I'm going to touch on efficiency, then I'm going to open up to some questions, have a quick a break for 2 minutes so I can catch my breath. So gross margin. And the next one is efficiency. Now, this is another key indicator. It doesn't appear in this format on your management accounts and P&L, but basically time worked over hours available. So what this means is if you've got people working for you, it could be in the office or on the shop floor or producing or whatever it is, let's say they work 40 hours a week. How much time are they actually spent working, producing goods? And you ask people this question, and regularly they'll say, well, my people or me, whatever it is, I've got 40 hours a week, a standard work week. I reckon I'm productive, if you like, for about 35 hours. No, they're not. It's been shown that only about 3 hours a day, maybe 4 hours a day max. So if somebody's working for 8 hours a day, they're only actually working, producing goods and services and adding value to clients for 3 hours, maybe 4 hours max, that sort of thing. So when you need to measure this for your people, now, can people be 100% efficient? No, of course they can't, because they're going to have to breathe and have a coffee and drink and walk around and have a break and get a bit of thinking time, this sort of thing. They're not robots, but don't assume that people are working to their full efficiency. The number of surveys been done around this in terms of efficiency and productivity, we'll touch on a second too as well. It's lower than you think. It just is a lot lower than you think. Even for your own efficiency, you think the time you work is time you spend working. How much time do you spend in the office a week? 40 hours, let's say. How much of that time is actually on added value services to your clients, billable work, if you like? And you might be surprised anyway, but for your team as well. So 20 hours over 40, it's only 50%. It's a good indicator, a good measure to have. How efficient are we with the use of our labor, basically? What's the use of our labor? So on that note, I'm going to just go grab a quick drink of water. I'm going to stay here, but any questions, anything, any thoughts, any questions, anything not making sense you'd like me to repeat or wasn't clear, just type it in. We can unmute and just kick it around a bit. And if you don't ask any questions, I'm going to pick on somebody to ask you what's the one thing you've learned. So there's no escape. So ask questions quickly. Any questions, just please type them in, and I'll do my very best to answer them. If not, I'm going to pick on somebody and ask them what they think. And I'm going to pick on Dejan because he's top of my list here. So if you want to save Dejan from being picked on, now's your time to ask a question.
Well, thank you for I will not ask a question. I will say I just wish I met you 5 years ago. Yeah,
happens a lot.
So far, it's been a great process of reminding myself all the things I had to learn by the hard way with practice.
Yeah.
Because we managed now in 4 years, the company got quite big and international. So a lot of this stuff, I went with the same approach as you, Dave. Very normal way, without balance books. Just let's use the time properly, let's set the margin properly, and all these things.
Yeah.
So it's very, very good course. I enjoy it now very much. So.
Perfect. Good. I think the thing is, genuinely for most of us, You know, we figure this out as we go along, and we just do. It's one of those things. We tend to realize we're not making much money, or we haven't got cash. We go, well, where's it gone? Oh, we figure it out, and that's, you know, and that's what I did. You know, I worked for other companies, other businesses. I was very fortunate. I was like a troubleshooter going around companies within the group, trying to figure out how they would, you know, get the profitability back and this sort of thing. So I was taught these things at, you know, an early age, if you like, thank goodness, and I just built it into my own businesses and those for my clients. But I think, you know, so many people, they intuitively, we know these things. There's nothing particularly new here, you know, really.
Not rocket science, right?
Exactly. We know this stuff, but it's like, oh, we learn the hard way that we've got to put the controls in place. And of course, the elegant way of doing it is do this before you pay the price for it. But anyway,
we call your system, actually, I have the name for this system of yours, because a lot of people that are much more educated than I am in terms of maybe economics ask me, how did you figure all this stuff out? And I say, we have a word, it's called street smart.
Exactly, it is street smart, but and genuinely, and I find this through the work that I do, is that the most highly qualified people, if you like, they don't know this stuff. They have no clue, and it's the streetwise people, and there's lots more. There's probably 200 of these sort of things we could talk about. Actually, I'll try to whittle them down a little bit, but there are some things that these aren't sort of in the textbooks and that sort of thing as well, and we figure it out as we go along. And what I find is that these are what make the biggest difference to businesses. It's not what the textbook says; it's what you have to do to go in entrepreneurial mode. So perfect, great, good, thank you. Anybody else? Any questions? Any thoughts or observations? Who have we got down here? I might pick on somebody else now as well. Can I pick on the embassy in Sofia, because you kind of left your camera on? Just what are your thoughts so far? Are the things you sort of, any sort of flashes that you think you need to sort of remember or refresh or build into what you do? Anything, any bright ideas come through for you?
Thanks, David. I will take the floor. For us, it's really interesting, but also a lot of overwhelming information, I might say, because what we do actually with my colleague, I'm a business, trade and commercial advisor at the embassy.
Okay.
So businesses, how to get better connected with the local community, the local businesses, making contacts with government organizations and stuff.
Yeah.
But I always had this gist to learn how businesses run and what it takes and what knowledge you need in order to be efficient in your business affairs. My colleague is dealing partly with accounting, with payrolls and stuff.
Okay.
She's an operational manager. So for us, there is a lot of information that we need to digest, a lot of new terms. I'm sure in the end of the day, we'll make use of it in all senses.
Good. Okay. Well, excellent. And I think it may be, and I find this when it comes to having people maybe come from banks and they sort of look at these sort of things, even if you're not maybe using these in your day-to-day business, if you like, but it may give you a range of questions you can ask, you know, your customers and clients. Because if you say to somebody, you know, what's your sales conversion rate, they won't know. They have no clue. But it's a good conversation starter, because it's a key driver. You know, what's your gross margin? They don't know. Maybe they do know, maybe they don't. Maybe just enables conversations to be had to help them look forwards, perhaps. Anyway, excellent. Okay, good. All right. So I've had my drink of water now. I'm okay, and we'll press on. So number 12, productivity. Now, productivity is different to efficiency. So productivity is a measure of what is the output per hour. So if somebody's only working 20 hours a week, actually out of the 40, they're 50% efficient. But what do they do with those 20 hours? What's their output? And this comes down to in professional services or all sorts of businesses as well. So it's output over time worked. sort of units per hour, output per hour. So if somebody's doing 100 units and they take 20 hours, then they're doing five units per hour. That's how it looks. Now, how this shows up in business would be, it could be maybe telemarketing is an interesting one here. So we've got telemarketer working 5 hours a day. How many phone calls, how many handset movements is that person making? So their efficiency is how many hours are they on the phone for the working day, and their productivity is how many handset movements are they making within those hours they're doing. That's a very sort of blunt way of looking at it. But what you'll find is that people will, from a management point of view, there's no escape. There's no escape from either efficiency and productivity. So if somebody is saying to you, I'm highly efficient, I'm actually working 7.5 hours a day, that's great. I don't think they are, but maybe they are really, really efficient. Then look at the output. How productive are they? Because if they're working 7.5 hours a day, I doubt it, their productivity is going to be low, I guarantee. So we want to measure both efficiency on the one hand and productivity. So how this shows up would be in the accounts would be a direct cost, cost of production, or if they're not very productive, they're a lot of time wandering around or drinking coffee and in meetings. Meetings are probably the #1 killer of efficiency and productivity in business. The number of meetings that I've unfortunately been invited to, and I go to them, and you sit there in the room of like 10 people for 3 hours and nothing happens. It's just wasted time. So meetings are highly unproductive in most companies. As a quick tip on meetings, I've got a couple of clients in Luxembourg doing this. They have a meeting. It starts at 8 o'clock in the morning, and you come into the meeting room. If you're not there at 8 o'clock, the door is locked. You can't get in, so you're not allowed into the meeting room. The meetings are all held stood up. You can't sit down. You're stood up. And I guarantee those meetings are fast and quick and productive, and they allocate jobs and tasks, and they feedback next time round. These meetings take 20 minutes, no more than half an hour, because these meetings are dragging on. And I know we've all been to meetings where we sit there and there's some old boy warbling on at the front, normally the chairman, and nothing happens. It's just a real a suck of time. So watch out for that. So measure efficiency and productivity. And this applies to office workers and factory workers, retail, the whole thing, accountants and lawyers, coaches like me, and maybe what you do as well. You can measure your own efficiency and productivity. Maybe you don't want to share it with other people, I don't know. But what I do when it comes to time management, Lynn, my boss, my wife, she manages my time for me as well. So I have a diary, a calendar, and meetings and calls are slotted in on a regular basis. So obviously this workshop has been booked now. Sarah, thank you for about a month now, 6 weeks, all booked in, ready to go. So I know what my efficiency is like, because I can tell in an 8-hour day how many meetings do I have. So Lynn keeps me busy, but then I look what eats away at my time. Where does it go? And it might be, I had the Windows did an update for me. Thanks, Windows. It took about an hour and a half for Windows to update. Now, if I sit here watching Windows update, that's dead time, absolutely dead time. Eats into my productivity, eats into my efficiency. I want to run my business, and if you're running your own business, I recommend this one for you as well. I want to run my own business 3 days a week. That's it. Tuesday, Wednesday, Thursday. I don't want to be working Mondays and Fridays, because I want to have weekends. I'm actually sat in, I'll show you guys later. We bought a little renovation cottage during lockdown in the middle of France. I've got a cottage to renovate. We've got chickens and rabbits and dogs and all that sort of thing to go and look after. I want to run my business 3 days a week. Now, if I was running my business without Lynn, my work would spread to 5 or 6 days a week. I guarantee it would. I would just, like oil on water, it would spread. So could you do your job in 3 days a week? And it's a challenge. And most people go, no, of course I couldn't. I'm busy. Actually, when you look at it, you could probably get it down to at least 4 days a week. Or 3 days a week, because what happens is all the stuff we do in between, meetings or wandering around or whatever it is, Facebook, LinkedIn, Instagram eats away at our time. So watch out for your own productivity and efficiency. And what it means is, what we can do, for example, if somebody wants me to deliver a one-day workshop somewhere, which has happened over in the UK now, it's either Monday or a Friday. That's it. I can't do Tuesday, Wednesday, Thursday. That's our client work. We're booked with coaching clients and virtual Zoom work, all this sort of thing. Physical workshops, Monday or Friday, that's it. So we can book that, not anything else. But I'm really clear that I want to get my time down, my efficiency up and my productivity up, me personally, and I recommend it for everybody on the call as well. There's quite a lot of work being done on this by a guy called Andrew Barnes over in New Zealand, and he wrote a book called The 4-Day Week, 4-Day Work Week. And what he said to all his people, I think it was an insurance company, he said to all his employees, look, I want you to only work or be present 4 days a week. Work 4 days a week. I'll pay you for 5, but the deal is you've got to do as much work or output as you were doing in 4 days a week as you were in 5. And of course, he presented this to his board, his CEOs, and they went, oh, it sounds a bit iffy, a bit dodgy. And he did it as a project. So he let people choose when they're going to work. Was it take Friday off or Monday off or half day Tuesday, half day Wednesday, whatever it's going to be. And what they found was that everybody could do 5 days work in 4 days time, and it would go much more efficient, much more productive, much happier, much more flexible. Staff retention went up, morale went up, and output went up as well. They're actually doing more in 4 days a week than they were doing in the original 5 because they had the choice. So I think this is a really interesting one to look at from a efficiency productivity point of view for people in your teams, but also for you as well. And for me, I've looked at it. If I was not managing my time, or Lynn wasn't managing my time for me, the work that I do, I guarantee would take 5-6 days a week. It just would, because work fills the time we give it. So give it less time, force yourselves to be more productive and more efficient, and maybe for your teams as well. Don't just beat them with a stick, but there's efficiency, productivity there. And of course, that will then filter through to improvements in your direct costs, gross margins, that type of thing as well. So productivity, efficiency, in my opinion, two key drivers. Okay, so we're approaching the halfway point now, which is we're all bang on track. Number 13, very generalized term here, but overheads. What are your overheads? Now, overheads really is every cost in the business that is not a direct cost. So overheads would be classically electric, gas, heating, rent, office services. It could be insurances. It will be depreciation as well. I'll just touch on depreciation for you a little bit. Other things, but you've got to account for every cost in your business. If it's not a direct cost, by definition, it's an overhead. Now, there are terms out there you may come across. You'll have indirect costs, you'll have flexi costs, but don't get too hung up on that. Basically, for what I think we're talking about, you've got direct costs associated with the production, and everything else is an overhead. So you may be an overhead in your business, you may be a direct cost. I don't know. You can be in both. Half of you is a direct cost, half of you is an overhead. Typically, things like holidays, sick pay, what I would call national insurance, payroll taxes, if you like, will go onto overheads as well. So we have a thing in the UK, for example, called national insurance, employers' national insurance. It's a payroll tax that goes into overheads. Maybe pension contributions, it's an overhead as well. Insurance will go into overhead. Now, one of the things here just to bear in mind, I'm not going to get a lot of detail for this because we are going to get very detailed, but let's say, for example, you pay your insurance for the year. You pay your insurance in January for your vehicles or your property or whatever it is, and it's €1,000. You pay your insurance in January. Now, where does that appear in your accounts? So because we're on called accrual accounting, what happens is, without going into all the details for you, but anyway, that payment will go as an asset onto your balance sheet because you've got insurance, you haven't yet used it, it's an asset on your balance sheet, but you'll only take 1/12 of the cost each month. You're amortizing it over the year. So you pay £1,000 of euros in January, but what you can actually do, you're going to take 830 euros per month. Regardless of when you pay it, you may pay the insurance in January, but the benefit of it is being spread over accrued or amortized over the year. That's how these accounts will work. So we're disassociating cash from value. So that's where the overheads will show up. So the overhead should be reasonably consistent throughout the year. You may have things like they're in training costs or whatever it is. It's an overhead, but have a budget and a forecast. We'll touch on that with some templates for you a little bit later on. Be really clear what's an overhead, and then what is your direct cost as well. Now, most people put things into overheads. It's a catch-all for everything, where it's just any expense, it's just, oh, it's an overhead, and they lose it. So when you look at their schedule of accounts, there's not much detail in there. The more detail you can get, it is a bit of a pain, but the more detail you can get, more headings in your accounts that you have, the better, because then you can measure it, you can manage it, you can identify it, and then you can reduce it, because overheads are a burden on the business. We want to get the overheads down as far as we can. And this is where I was speaking about earlier on about marketing. Marketing will appear very likely as an overhead in your business. And for every overhead you have, we want to know what's the benefit. Why am I paying insurance? Why am I spending on marketing? Why am I paying this for electricity or gas or whatever it is? And one of the things that we do, and you can try this out as well, is I want every overhead line in my business to contribute towards our sales figures. So what I mean by that is, for example, my insurance. So we've got an insurance broker in Luxembourg, and we contacted them some years ago. Said, look, we've got to insure our business in France and Luxembourg. We need public liability, we need employers liability, all this, we need an insurance package. I said, you know, what can you do for us? Here we've got 5 people, all the employees, and there's me and all this sort of thing. What can you do for us? And the deal was, look, I'll give my business to you as an insurance broker, because I think you do a good deal. That's great. But the deal is this: I want you to introduce me to your clients as well. I'd like to run a workshop or a little quick sort of seminar just for your clients. You can invite, I'll do it for free, but I want access to your other clients, because those other clients may become clients of mine. So I can use my insurance expense as a marketing expense. I don't want anything I'm spending to be lost in the business. So I will say to my insurance broker, we did this in the UK as well, for example, with our mobile telephones. And we were using Orange back then in the UK. And I said to my Orange phone provider, look, I love you guys. Prices are good. We're going to go with you. Again, all the handsets, the car phones, the mobile phones, we're going to go with you. But the deal is, I'd like you to introduce me to your other customers. Referrals, introductions. I mean, sure, that'd be great. They introduced me to one of my best ever clients, the Orange telephones. They introduced me to one of the best ever clients in the UK. We're still, this is 14 years ago. We're still, working with them now. We're still in touch with them now as well. They were great. I would never have got through to them if Orange hadn't have introduced me. And how it turned out was the lady at Orange was having a meeting with this other person, and he was talking about his business not going great and all this sort of thing. And she said, well, you need to have a chat with Dave. He's a good lad. He's a good bloke. Have a chat with Dave. He might be able to help you. That's all it was. Had a chat with him, had a meeting, off we went. So I want to make sure that my overheads are working for me. Whatever I spend, I want it to work for me in terms of a benefit or leads or introductions or whatever it's going to be. It's really, every cost is a marketing cost. With the rent that you're paying on your premises, for example, rent is arguably a marketing cost, because it's location. People are seeing you. You get your signage up, get your banners up. If I'm working, we did this in Luxembourg as well. We went took some office space out in Luxembourg in a big shared unit. I said, look, we're going to come to you guys, absolutely, pay rent, didn't quibble on the price. But what I'd like to do is do a special offer for everybody else in the building to have discounted access to workshops and seminars and this sort of thing. No, that's great, love it. That they looked good because of it. I helped them look good. They were unique in the market. All their tenants had discounted access to our little, seminars and webinars, that sort of thing. We do half-hour bite-sized workshops, that sort of thing. And from that, when they see what we do, maybe they want to work with us. So if you're spending anything on as an overhead, just see if you can make it work for you, not just in the service that you're getting or the support you're getting, but what can they do to support you that's a bit different. Do it with a smile on your face. Don't be too heavy-handed. But every line that I spend money on, we all got overheads. We all got overheads. I want to make it work for my business, and you can too. Whether it's phones or insurance or whatever it is, you can probably find a way of getting that expense to do something positive for your business as well. Otherwise, we want to reduce our overheads. Overheads are something to be reduced. They're a burden on the business. So we really want to know, what are we getting back? Certainly with marketing, marketing is a key one. It's a big drain on costs if you don't do it properly, not very careful. But every line of overhead, when you fragment it down, so what your accountant will call it is going to be, it's called a ledger, or they'll call it nominal codes. They'll give a code to every overhead line, lunch or dinner or time or training or rent or power, whatever it is. And all you do is you say, well, here's an invoice, you put your nominal code on it, and it goes to that line. And when you get your accounts, it's all coded down for you. You can see what you're spending on whatever line. So it's a key one, management tool. Don't just let your overheads be a pot of stuff that is just, stuff gets put into it. I do recommend you allocate it. We're not a very big company, we're not a huge company. We have about 40 overhead lines in our business because we fragmented all the way down. We get our profit and loss account, management accounts every month, and we check it and make sure we're on track with our budgets. But I do want those lines to work for me. It's an interesting one. Okay, so that's overheads. Now we can then look at overheads that drive efficiency of our overheads as well. Now, this is different to gross margin. This is overheads expressed as a percentage of your gross margin. So normally overheads, you can say, well, our overheads are a percentage amount based on sales, whatever it is. But what really your overheads are doing, the only reason we've got overheads is to produce gross margin. That's it, not sales. We're really interested in gross margin. So the reason you have an office or a building, or you have people or systems, the only reason you have them is to actually generate your gross profit. That's what you're doing. You're generating, the engine is running to generate gross profit. So you can look at that. So overheads are 50,000, gross margins 100,000, therefore 50%. My overheads are 50% of my gross margin, the value, the gross margin, the gross profit I'm making. How can we get that down? How can we get more out of these overheads? Because too many people, in my experience, they just let overheads just run. It's a necessary evil. They just run. We've got to have it. We don't want to have an accountant, but we've got to have one. We don't want to have all this going on, but we've got to have it. Well, yeah, you do, but you do want to make sure also that you're getting the best value from the money you're spending. So this is where, from an overhead perspective, identify each line, make each line sweat the overheads, and then check on your efficiency. Because if I've got an operations manager, office manager, or production manager somewhere in my company, a key driver could be, I want to get either more gross margin with existing overheads. I don't want to increase my overheads. I want to get more going through it, or keep the same gross margin, but get my overheads down. How can I get my overheads down, be more efficient, more productive in my offices as well as on the shop floor? And again, just in my experience, not many companies actually look at this. They look at their production area, gross margin, gross profit, absolutely, but they tend not to look at the overheads. What they will do, classically, somebody will come along and go, right, we're going to cut overheads by 10%. Off you go. Well, that's ridiculous. Because if you've got some overheads that are serving you, like the Orange telephones, I don't care what Orange telephones charge us, because they keep feeding me clients. It's actually a marketing cost. So I do care what they charge us, but I'm not going to sort of get rid of Orange telephones, because it is a big cost in my business, but it's generating leads, appointments, and business coming through. And we actually worked for Orange telephones themselves because we did training workshops for them. So I'm not worried about it, because I'm sweating the asset. If somebody says, well, let's just get 10% out of overheads, I mean, the principle is okay, but it's a very blunt instrument. So the first thing to do, I think, with overheads is identify them, and then look at which ones are serving you and which ones aren't. If they're not serving you, great, cut them or reduce them if you can. Those are the ones to go for. But if you get every overhead line working for you, well, then great, away you go. If you've got office staff, for example, can they work for you in terms of generating business Of course they can. They can refer people to you. They can bring along great ideas. They can introduce their family and friends to you, whatever it is. They can also be helpful, and they can say nice things about you when they're in the pub as well. I was sat on a plane. I was sat on a plane going from Luxembourg when we could fly, Luxembourg to London City. It's a 40-minute flight. Quick hop over to London from Luxembourg, and in front of me there's two guys, executives from one of the big banks in Luxembourg, doesn't matter which one, and they're both dressed the same. They're both dressed in the uniform of bankers, which is navy blue suit, white shirt, brown shoes, and maybe a red tie. They look like little sort of clones to a certain extent. And I could hear them talking, and they were talking about their boss. They got the same boss. My boss does this. Yeah, he's a nightmare and this, that. They hated their jobs. And I thought, my goodness. And I knew what bank it was as well. And it was my bank. And I thought, crikey, I don't want to know that these people are talking about my bank, that we bank with in those terms. So everybody on your payroll, everybody in overheads, they can all contribute to the positivity of the business by referring, bringing people on board, saying nice things and that sort of thing as well. So sweat the asset and look for that overheads efficiency as we go along. So we're coming up to sort of the halfway point in the workshop. I'm happy to continue. It's absolutely fine. Do you want to take a 5-minute break? Go and grab a coffee, bit of a rest break. People are nodding, I think. So should we take a 10-minute natural break? Would that be okay? Natural break. So I'll stop recording and leave everything on for now. You're quite safe. I'll stop recording. We'll kick off again in 10 minutes. So at 25:02, if that's okay. And then we'll wrap it up for the second half. So I'll stop recording now. Let's go to pause. And I will see you. There we go. So I think we're looking for people to, hi, we're back. Yes, I think, excellent, good to see everybody. And I've had to go and get the Labrador out of the office because she thought it was food time and it's not. So I had to escort her down to the garden. Anyway, all good fun, all good fun. Okay, so I'm assuming everybody's back with us. I'm just everybody's here. Yep, a couple of people dropped back in, so we're good to go. Okay, so before I'm happy to start again. Are there generally any questions? Because I'm conscious this is a lot of information. One of the challenges with finance and accounting, that sort of thing, can be pretty detailed oriented. Is it has a pace? Is it too fast, too slow, or about right? Just give me about right. Is it okay? Everybody keeping up? Am I speaking too fast or no? I'm okay. Okay, good. And any questions? Is there anything else you'd like me to explain again or go over or make clearer perhaps that wasn't? Happily, I'll do that. My time is yours. It's absolutely fine. If nobody asks any questions, I'll take it. It's going okay, if that's right. All right, so we'll kick off. So we've covered sort of overheads, but again, just make sure overheads, they should work for you. The key thing is they should work for you. When you look in the textbooks, it'll say overheads are a cost to be avoided. Well, they are if they don't work for you. So find a way of making them all work for you as well. Okay, so number 15. Is a net profit. So we're working down the P&L now, the profit and loss. Total sale, net profit is total sales minus total costs equals net profit. And that's what it looks like. So 100,000 sales, total costs, that's direct costs and overheads combined, total costs, net profit, 10,000. And that's it. Now, why the reason we're interested in this figure, and during the break, I was just actually speaking to Lynn. We've been speaking to our UK accountants. They're producing our statutory accounts now for submission, and we want to get. It depends on your strategies, but this is why net profit's so important, because as business owners, is where you take your money from. So, do you take your money from the business as a wage, as a salary, so you're an overhead? Or maybe you're taking it as a shareholder, as a dividend. Well, your dividend is going to be derived likely after tax, after you paid tax on profit. So you're going to get taxed on your net profits somewhere, in most regimes anyway, tax on net profits. Do you want your business to make a profit? Now, this is a strange question to ask. Of course you want business to make a profit, but actually maybe you do, maybe you don't. We took a decision in our business for the last 12 months we didn't want to make a profit particularly. So because we were investing back in our business on lockdown, we wanted to get things done and make sure they get ready to go for the new year on the uplift. So we didn't want to make a lot of profit. So we're not going to pay a lot of tax this year. Tax is derived on the net profitability. So we took a decision to invest in our business, which reduced the profits and has reduced our tax bill. But as a business owner, of course, got to be careful with that, because if you're a shareholder, you're going to get your dividends, your income is going to be derived on the net profits after you've paid tax to the government. So you want to watch out for this. What happens classically, I see this a lot, unfortunately, is business owners will, oh, somebody's just dialing in, here we go. Business owners tend to take, and I don't know the tax regime that you're working in, so forgive me if this doesn't really apply, but it's certainly in the UK and sort of Luxembourg. Business owners will take a small salary, so they are paying lower income tax. They get a small salary and they pay less tax on the dividends. And again, tax is not my speciality. They take lower wages in the business and take it out of dividend, which is okay, providing the business is producing profits from which you can take a dividend. And what can happen if you're not very careful, if you take your eye off the ball, you take a small wage out, but then the business doesn't make a lot of profit, everybody else earns well, all your team are earning well, and you sit there and you're not making any money, taking any money out of the business. So net profit is one of the key drivers from a business owner perspective. You've got to drive key net profitability, because that basically is where you're likely to take your income from. And that this is what sort of net profit should be deriving? It depends on your business, depends on your sector, depends how ambitious you are. But certainly, and I've done it myself, is business owners tend, they'll subsidize the business by not taking their wage out, or the wage they deserve, because they're not pushing the business hard enough to make it work. So watch out for that. You should be paying yourselves first, almost, as business owners, because you're taking all the risks. So don't subsidize the business. But it doesn't work like that in reality. You get paid last. You get paid at the bottom right-hand corner. But net profitability, have a budget, and we're going to touch on budgets a little bit later on. Have a forecast, have a budget, have a net profitability target. Speak with your accountant, because you want to do some tax planning. There are things your accountant will advise you based on your levels of profitability, things that you can do to minimize your tax, not evade tax, avoid. Avoid is okay, evade is not. I'm not going to go to that route, but you want to minimize your tax. So something to think about. And this again happens in a lot of tax regimes. From the UK, for example, there's something called a research and development tax credit. If you're investing in research and development, you get a tax credit back for that. So there may be schemes in your area of jurisdiction where there's a similar sort of thing. So when you start looking at your profitability and your budgets and your forecasts, again, speak to your accountant, speak to a tax advisor, and not just run the business on the accounts, but do some tax planning as well. You may want to do things with your pensions or whatever it is, and the tax regime will be structured in such a way you've got to be quite clever about it. But I recommend it. My official advice: speak to your accountant and see how you get on. Okay. All right. So 15, net profitability. Have some key targets for that, but also net profitability in terms of margin, net profit margin. So we've got gross margin and we've got net margin. And again, this is a drive of efficiency in the business. So we have net profit divided by sales. So net profit 10,000 divided by sales equals 10%. Now, a lot of people will say, well, 10% net margin, net profit is pretty good. I don't know if it's good or bad. It depends on your sector, depends how good you are. I certainly have seen net profitability anything from, 2 or 3% for some companies, up to sort of 15, 20%, and in that range. So you should judge your business based on net profitability, but compare to other people as well. Is 10% net profit good? It depends. It depends on your sector. It depends who you're competing against. It depends if 10% serves you in terms of your requirements for income and efficiency and productivity as well. But have this as a key target, because that's where you're going to get paid from. So your accounts will give you this net profitability, and that's where you're going to drive it from. So these are really on the accounts. These are key performance indicators: sales, gross profit margin, overheads, sweat all the assets in there as well, and then net profitability. And for a number of people, they have literally a chart on the wall, and they will have a target that they're shooting for, and every month they measure it. Are we on track with all these KPIs? And what you can do is, you can go too far with this as well, if you're not careful, but certainly pick half a dozen key indicators that you would use in your business to measure your performance and progress. Is your net profitability higher than it was last year, for example? Is your gross margin growing, or is it dying? How's your efficiency? How's your productivity? And benchmark it for growth and performance. The reason for this as well is, if you're looking at any point to sell your business, you need a healthy set of accounts, or a healthy efficiency and productivity. The valuation of your business is likely to be generated or dictated by maybe on gross margin, gross profits, but also net profitability as well. If I'm going to buy a business, I want it to pay me back. So if you're looking to sell your business, then speak to your accountant. And what you can do, it depends what business you're in, of course. Let's say, and I've got a client doing this at the moment, for example, and she wants 10 million for her business when she sells it. So, okay, so what we're going to do, we've taken her accounts to her accountant and said, look, we want this business to be worth 10 million in 5 years' time. How should it look? What should our gross profit be, our net profitability, all the structure and the margins in there? And the accountants come back and she said, well, look, if you give me a balance sheet that looks like this and a set of accounts that looks like that, roughly that will be valued at 10 million. So now we've got a blueprint to work towards, from where we are right now to where we want to be in 5 years' time of the account. So we're going to work towards it so that in 5 years' time, she can hopefully sell the business for 10 million. That's her valuation that she wants. So it gives us a real control over our businesses from a point of view of operations, but also from a point of view of saleability. Another way you can work as well depends on your growth strategy, how you want to grow and build and develop your businesses. But if you're looking for investors, if you need cash in your business, strong balance sheet, good profit and loss would suggest that you're a good bet, that basically you're going to pay the money back. So investors look on it favorably. But also you can look at the franchising route, for example. You could maybe franchise your business. Well, you can't franchise a business really unless you can give a demonstrated performance of a business in the same sector. So if you can produce a good set of accounts, solid growth and performance in marketing and sales and deliverability and retention of your customers, when you systemize and structure that, it's sort of easier to franchise it and say to somebody else, here's what we can do. You can do the same. You're going to buy it from us or rent it from us, but franchising is a very interesting one. So all these things fit into your growth, strategic growth options and choices, whether you're opening another branch, going international, franchising or licensing or selling or whatever it is. But these KPIs so far, hopefully will give you an indication of control and performance that gives you, authority over your business, but also demonstrates a track record as well. And the banks love all this sort of thing. If you can go to the bank with a solid understanding of your numbers, and I did this with our transport company years ago. We had a cash flow forecast. I'm coming on to cash flow in a second or two. We had a budget and the cash flow forecast. And based on my cash flow forecast, in about 8 months' time, we needed about 150,000 because we had to invest in property and premises and all this sort of thing, and investment in IT, and the cash dropped. The sales were great, but cash dropped. That's the difference between sales and accrual. Took it to the bank and they said, yep, okay, we understand that. Because you've got a budget and a forecast and you understand it, we can see where it's going to hit in your cash flow. It makes sense. They're more prepared to fund it. We didn't get all the money, but we got some of it, which was really helpful. So if you get under control of your business and you can explain to your bank or your investors, this is what it looks like, it's how it's going to be in the future, then they're much more likely to say yes. I can't guarantee they'll say yes, but they're much more likely to say yes to a loan or investment and that sort of thing. Because the money's free at the moment. The interest rates are really low. It's a pretty good time to look to invest in things to go down the growth and development route. I think the COVID-19 situation, which has affected everybody globally, I say everybody, all of us on the call certainly, is beginning to ease off a little bit now. Certainly the UK is coming out. I was over there last week and the economy is sort of back on track. Inflation's creeping through in the UK. France, Germany, Luxembourg, same thing. opening up again. And I guess, I hope in your neck of the woods, things are opening up a bit more. Some companies haven't made it through this pandemic. Some have disappeared, which is tragic. But it does mean there are opportunities for those that are in control and have a demonstrated track record to go into expansion mode. So if you're in expansion mode, again, these tools and numbers will be hopefully very helpful for you to justify investment and go for growth. So net profit margin, a key driver. Now, something else that's not on the accounts as such, but I think is very important as a driver, is a break even. What's your break even point? So, and this can be a break even number, or one of the ones that I prefer is a break even time, a date or a time. So how do you work that out? So we run this for our business, but I have this as a KPI, as key performance indicator, with just about every client we work with. I want to know when they break even. So for example, I'll show you this. It's a bit complex, but well, there we go. You're all very bright, so I'm sure you're going to get it. So in a year, you've got this, you're making this much gross profits in a year, and in a year, you've got this much overheads. And the difference between your gross profit and your overheads is your net profit. That's what it is. That's basically what it is. Gross profit, overheads. That little gap there, the difference between those two is your net profit. So if you think of that chart representing 12-month period, it'll look like this over 12 months. So you're making no money effectively, even though your accounts will say you made a profit in January, February, March, and April. Overall, because we're looking at a 12-month view, you're actually not making any profit at all over 12 months until your total gross profit has covered all your overheads, all your expenses and costs. So that little gap there appears at a period of time in the calendar. So if you're making 10% net profits, that gap there is 10% of the year where you're making actual profits. So you're working for 90% of the year just to pay your costs, salaries, wages, and rent. The last bit is where you're actually making profit. You keep all that. You paid everything else. You keep all that. That's your net profit, your break-even point. So this is what it looks like. So it's basically this. It's your net profit percentage multiplied by time gives you break-even point. It makes sense when I put it in here. So 10% net profit times 12 months equals 10.8. What that means is if you're making 10% net profit, you're breaking even at 10.8 months into the year. That red portion there is sort of the end of November, pretty much end of November, third, fourth week in November. So what it means is you're only actually making money for the last 4 weeks of the year. I think that's too thin in the small business sector. Our break-even points should be earlier in the year. For us, we aim for August. I want to break even in August or by the end of August. Then everything else that we make, we can either invest it back into the business, we can buy stuff, or we can make profit, and it's a choice that we can make. So understand your break-even point. It's based on your net profitability. If you're making only 5% net profit, then you're only making profit for the last 5% of the year. Well, that's only a couple of weeks. So you're breaking even the middle of December in a 12-month period. Now, it also works on a week basis or a day basis. If you're in retail, we have daily break even. So if you're making 10% net profit on an 8-hour day, well, you're only making money for the last hour of the day, pretty much. That's what it means. So that might be too narrow, because let's say we have a problem in November. Well, then we're wiped out. We're not going to make any money for the year. We've paid all our bills, but we're going to get wiped out. It's very, very thin. It's a very sensitive measure. So 10% net profit means we're breaking even at the end of November, or at the end of the 7th hour, if you like, or by sort of Thursday, Friday lunchtime in a week. It's very, very sensitive. So don't be fooled by net profitability percentage. The higher you can get it, if you want to go down that route, is get that break-even point to be earlier in the year. I've seen companies that can break even by the half-year point. Depends what sector you're in. I have a client whose gross profit is only 6%. Only 6% gross profits, but they can still break even because their overheads are low. They can break even earlier in the year. So it's an interesting discussion point to have with your key managers, your shareholders, or your stakeholders. when do we break even? Of course, if you make a loss, you never break even because the overheads, where they extend out, you never actually cover it. So watch out for that. But the break-even point can be used as a key performance indicator. With the number of teams we have for a date in the diary for next year, for example, a date where they're going to break even by, and it might be end of September, October, whatever it is, whenever they choose. What they do, of course, for their teams then, just out of interest, they will say, well, if we break even by the end of September, not end of November, then there's a bonus. Because we break even early, we've got more profit coming into the business that we're going to get over the next 3 or 4 months. So they pay a bonus or a commission on the timing of the break-even point. And one of the things is then they don't have to publish all their numbers and profitability and everything like that. They just publish the break-even point. How are we doing? And they have literally a barometer on the wall, a big computer screen, and they're generating this profitability, climbing up towards the break-even point. Everybody can see it. Everybody's buying into it. They're all doing sales or marketing, whatever it is. And once they get there, they earn bonus, providing the bonus, the timing is as per the plan, they get bonus. It's an interesting way of rewarding people, but also making your visibility, the targets visible on the wall. If you've got a barometer for break-even point and a client walks in to your office, it means nothing. It doesn't say sales or profit or turnover or anything like that. It just says break-even point. And if we're not giving away, secrets, it's a very nice, elegant way of getting the profitability of the business up. It drives all the productivity and efficiency. It drives all the other KPIs as well, but understanding your break-even point. One of the clients we have over in the UK, they're a sales organization. They have an operational break-even point during the day. And if they can get to break-even point during the day by 12 o'clock, by lunchtime, they buy lunch. If they don't buy lunch. It's a nice little gift. So what happens is you've got to place your pizza order by 12 o'clock. So providing they get in their office, the sales office, all focused and break even point by 12 o'clock, then they phone, bring the pizzas or whatever it is, the food they're going to get, or a salad if they want to be healthy, of course. But they get rewarded for it. And what it does, it focuses people in a fun way as well on the key performance indicators of the business. Because if we break even by lunchtime on a Monday, Tuesday, Wednesday, it means we break even by end of week 2 in a month, which means we break even halfway through the quarter, which means we break even halfway through the year. And it really drives that performance, profitability, and excellence, and you reward people for it as well. But as we know, if you've got, I think there's 8 people in their team, the sales team, if they buy pizzas every day, if they're breaking even at halfway point, all the profit comes in the afternoon, they're onto a winner. It's a guaranteed win. The team know that. Bit of fun, quite engaging, but they've got to measure it in order to manage it. So break even can be a daily break even, or weekly, monthly, quarterly, certainly annually. But it's an interesting one to look at. Ever so easy to calculate. You put it on in your net profitability. So if here it was 8 hours, for example, well, you just change the 12 to an 8, and it gives you the number of hours or the percentage of time you're going to before you break even. Very simple to work out, and a very nice, elegant one. Doesn't show up in your P&L. Your accountant may talk to you about this one or may not, I don't know. Perhaps they do, perhaps they don't. But as a conversation starter, I'm just thinking of the team there at the embassy in Sofia. You could say to maybe some of the people you're working with, for example, to what time of the year do you break even? And then very likely to go, what are you talking about? I have no idea. What time do your gross profits cover all your overheads? Oh, I don't know. Now, maybe they do know. Maybe I'm doing a disservice. Maybe they do know. Well, great. And if they do know, well, how can they improve it? But having that as a measure, most people don't know this. I guarantee. I don't know anybody on here. Is anybody on here measuring this just out of interest? Anybody measuring? Just nod. No. Okay. Well, good, because now you can. It's an interesting one. Very simple, straightforward one. It's not strictly accounting. It's sort of finance as well. But when you ask questions of people, if you want to look clever, ask them 2 questions. What's your conversion rate and what's your break-even point? And they won't know, I guarantee. It's a good party trick. And then you can obviously guide them through, and you can say, you got to watch the recording of this training or something like that, whatever. Speak to Sarah first about that one. But there you go. Anyway, so break-even point, very interesting measure. a key performance indicator, and also good for rewarding people and letting them know how the business is doing. And I share information with people. I always have in all my companies, and I recommend with my clients as well. Let the team know how you're doing. Now, whether you want to share the profit and loss and the cash balance, all this sort of thing with people, maybe not, but certainly conversion rate's an easy one. Sales conversion rate, an easy one to share. This one, again, easy one to share because it's a break-even point. Here's where we are. Why is it good? It's good because we can invest in our people. You get rewarded for it, and it's a nice thing to put up on the wall as well. So there we go. Break-even point. Okay. Any questions? Everybody happy? Oops. Everybody happy? Making sense? Good. I'm gonna have a quick drink of water. I didn't know I could talk for so long. My goodness. By the end of the afternoon, this will be vodka, I think. But anyways. Okay. So cash flow. Now, again, this is a key driver. It doesn't appear in your accounts because accounts are accrual-based accounting. They're a measure of transactions, not money. But this is a key document to have. This is a cash flow forecasting tool. I'll send it across. You're welcome to have this. It's pretty basic. There are more elegant ones out there. If you have an accounting package like Xero or Sage or something like that, very likely your accounting package will have something in there anyway, so you can get your accountant to take you through it. What cash flow does, it measures just the timing of transactions, when cash comes into your account and when it goes out. So what can happen if you give credit terms, for example? So we offer to our clients, to our favorite clients, credit terms because we do a job, we do a project or a conference or something, we invoice and we say, well, you can pay us in 30 days time or something like that, which is okay because, we trust people and they will pay us. But there's a gap. The difference between my cash coming into the business and the point at which I take a sale. And I can predict that. All right. Okay. Yeah. Excellent. There we go. Yep. Yes, you can. Yep. Sorry. Yeah. Good. So I'm trying to catch up on notes as well. Yes, you do. So I would do a forecast, a profit and loss account forecast, a budget, and then based on my credit terms or my debt, whatever it is, when do I pay my suppliers? When do I get money from my clients? When am I going to spend money on insurance, for example? Because I've got to, even though I'm taking a 12th of my insurance into my accounts over the 12-month period, I've still got to pay the insurance premium in January. So cash goes out. So even though I'm profitable, my cash might dip. So I recommend you have a cash flow forecast. This one runs over a 12-month period. I'm sorry, this is a quarterly period. You can do it over a 12-month period, whatever you like. Keep it refreshed and monitor it as you go along, because cash is the only thing that kills a business. Lack of sales doesn't kill a business. It hurts, doesn't kill it, because you can always put some money into it. Profits and margins, they don't kill a business. The only thing that kills a business or knocks it over is cash. I guarantee it. Cash in the bank. And if you predict your cash flow and you can see gaps in it or coming through, you can do something about it. You can either bring down the rate of money that you're collecting in from people, or you can go and do some deals. You can speak to the bank or whatever it is. If you can predict it, you can manage it. And this is a very elegant way of doing it. Banks love this. If you go to a bank manager with a cash flow forecast, they're going to do wonderful, because it's safety and security. It shows you know what you're doing. If you go to the bank and say, I'm in trouble, I need 50,000 today because I can't make payroll, then you're not a very good bet, if you're being blunt. Whereas if you go with a cash flow forecast and say, in 6 months' time, I need 50,000 overdraft facility or a loan or whatever it is, because I've got a short-term blip in my cash flow, not guaranteed, but a bit more likely to say, okay, it's under control. You know what you're doing, makes sense. We understand it. And here's some money. Off you go and get on with it. So I recommend cash flow forecasting. You may find it in your accounts package. Your accountant will take you through it, but very, very well worth doing it. I'll send this template across, so Basira will have this one, and you'll see on all the spreadsheets and things I send over, it says here a little blue thing, see instructions on page 2. So there's a second tab on the spreadsheet. It'll tell you how to do it. It's a bit blunt, a bit of a blunt instrument. It's pretty good. All you do is put money coming in, money going out each week, and it measures it for you and gives you opening balance and closing balance. But I recommend it. Gives you control. Then we have another sort of visualization of cash flows called the cash gap. And this is a way you can sort of visualize it. Now, this is just something to bear in mind when you're doing deals with people. On here we have, this is a company with stock. You're buying inventory in, you pay for the inventory, then you're gonna sell it, but there's a gap, and this red time here that between cash paid and cash received is your cash gap. When you pay for the goods and when you receive money from the products you're supplying, there's a gap, and it's more than just the time that your debtors on your invoicing, because you've got that gap when it's sat on the shelf doing nothing. So this is another visualized concept that you can use working out your cash gap. If you Google cash gap, you'll find all these. There's different calculations and that sort of thing you can have a look at, and there's different ones for service industries when you don't have stock, for manufacturing companies when you do, or warehousing businesses. But this cash gap is an interesting one to have, and if you've got managers working for you in different departments, this is a very good way of explaining to them, because they tend not to think in terms of cash. They think in terms of people and transactions, which is great, but if you want people to grow through and support, manage the cash for you, they need to think about this. They need to think about, when do we actually get paid? Because salaries and wages are paid out of cash in the bank, so we need to make sure it's there for them, and they can focus on it. It can be a KPI for people. Certainly if you've got a bookkeeper or accounting team or whatever it is, operations team, cash gap can be a very interesting KPI. And again, you can have it on the the barometer on the wall as you go along as well. I have a client in sales, not too much to do with the cash gap, but they have this break even thing, and what they do is when they get a sale, they have a balloon, a gas-filled balloon that is in the ceiling, and when they win a contract, they can shoot one of the balloons with a little air, like a Nerf gun with a pin in it, and inside the balloon is a gift. It could be some cash, it could be a pizza or whatever, a pizza token, all this sort of thing, whatever it is. And they're so motivated by that. When I go to the sales office, they're literally waiting so they can start. They've all got a Nerf gun. If they don't hit the target and don't shoot the balloons, they start shooting each other. And they all shot me when I was there last time as well, which wasn't very nice, but still, there we go. But yeah, cash gap, it's a visualized method of finding when do you spend cash, when do you get it, and what's the gap, the receivables coming in. A nice way to have that. Again, you can sort of pin it on the wall. Okay, one of my favorite ones now, and the next one is my favorite one, is the budget. And again, this template, I call it the fun budget template, because I think budgeting should be fun. Again, you may have this on your accounting package like Xero or Sage or QuickBooks, whatever it is. Obviously use that one. If you're unsure, go through it with your accountant and they'll take you through it. But we do this, we use this particular template to predict the next 12 months. What it will do, it will work out for you. Here we go. It gives you a break even. It'll tell you based on what you're assuming on the screen, that little green box there. I don't know if you can see my mouse moving on the slide. It'll calculate for you break even day in 365, so day 274 or something like that. So based on what you're predicting, it'll work out your break even point for you. These graphs and charts down here, they plot your sales pattern, your profit pattern throughout the year. And it gives you other dates. There's a quarterly cumulative thing on there as well. So it's not there to replace your accounts package by any means, but as a tool, I sit down on maybe a Sunday afternoon somewhere with Lynn over a glass of wine or a coffee, and we build our budget for the year. And we put what we're going to do, how we're going to get there, what's it look like, what's going to happen in terms of sales during the year. We've got gross profit calculated. There's our budget, there's our forecast. I think it is fun. I like to spend a bit of time, looking at my forecasts, my budgets. And from that, I do this first, and then we do our cash flow forecast second. So budget first, cash flow forecast second, because the cash flow is dependent on what we put into the forecast, into the budget. But this covers all things from monthly sales. You can see all the overheads on the left-hand side. You can put other ones in there. We've got quite a few. We log down. And what this one does, so if I put in there, for example, rent of 12,000 for the year, it automatically goes, oh, that's 1,000 a month, 1,000 a month. It amortizes it over for you. So ever so easy, just fill the yellow boxes in. It's very straightforward. But this one is really a tool. I would share this then with my managers, my team, and say, this is where we're going to be going next 12 months. For my marketing team, here's the sales target. here's your conversion rate targets. Away you go. Here's your budget. Off you go. Go and do your marketing stuff. My operational team, same thing applies. And what you can do is you can lift out from this the master document sub budgets, if you like, little documents for one for operations, one for marketing, one for sales, one for the warehouse, one for manufacturing, whatever it is, and give them some responsibility over their particular aspect of the budget, and then they can report in. Something you can use lying over this, if you like, is a thing called OKRs. I'm sure we've come across OKRs, organizational key responsibilities. I'll send a link over to you. It's something that's used by a lot of the big guys are using this now, the Microsofts of this world. I've got a number of clients using OKRs. And what it basically means is we have an overall target budget forecast for the business, and we fragment it down so everybody in the business has got their own targets to go for, typically 3 goals, 3 targets that all point towards the achievement of the company goals. Sounds very straightforward. It is straightforward, but when you can formalize it a little bit, it starts with your budget. You can build into this sort of seasonality in your business, for example, and then you can walk out of there with a solid target for 2022 from January, whenever your year starts. We're doing our planning in November for 2022, and we always have a budget, and then we compare, obviously, our accounts with our budget. Now, as a tip, if you're using an accounting package, try and get your budget template or budget format to be the same as your accounts format, so you can compare the two. So you've got the same overhead lines on there, the same structure, so you can compare your actual with your budget, and it just makes it easier to sort of compare notes as you go along. And that helps in terms of measuring it, but let your managers measure as well. We then have monthly accounts, and then we have weekly KPIs. Certainly, I'd set a monthly management accounts and compare it to your budget as you go along. Does everybody use a budget? It's out of interest. Everybody got a budget? They use a budget at the moment? Are you budgeting in your business, or not so much? Just type in a yes or a no. It doesn't really matter. I'm just interested. I find that too many people don't have a budget. Excellent. Good. Good. And Image, what do you use? Just out of interest, what do you use for budgeting? Are you using your accounting package, or how do you do it? Just maybe just type it in, or I'm always intrigued. Good, you've got one, but how do you derive your budget? What system are you using? Okay, good. Okay, there you go. Great, good. That's fine. I mean, this template is based on Excel. I would suggest officially we use an accounting package, but it depends. Excel is fine if you can do it on Excel. Much better than nothing, and providing you can compare notes, away you go. So yeah, good, excellent, good. Okay, any questions on budgeting? Any questions around budgeting? Is a huge subject. I'm sort of skimming over the top a little bit with budgeting, but any questions? Everybody happy with the principle? You get the templates anyway, and you can have a play with it. It is fun. It is a fun budget to have. Okay, good. All right. Now we're moving over now a little bit towards these are balance sheet things, but this is debtors. This is a measure. This is cash, so it's off your profit and loss, and really showing up now on more on your balance sheets. So this is the trick. But the thing with the balance sheets is it's great, but remember it has things we own and things we owe. So when you own something, it could be you own a debt. So you've got an invoice you've raised on somebody. It's an asset to the business because it's money due to come in. When they pay that money to you, cash comes in, you're no better off, because on the balance sheet, it just goes into cash. So it transfers from a debt into cash. So it's no better off. It doesn't give you a very good indication. But a great measure of how effective you're measuring and gathering your money, trade debtors, is to measure your debtor days. So trade debt, how much money is owed to you in your business right now as a snapshot. Let's say you've got $100,000 euros owed to you, and your annual sales is 500,000. Well, then multiply by 365 gives you 73 days. Now, what it means is that it's taken you 73 days on average to collect the money in from clients or customers. Now, if your standard terms are 30 days, or maybe 60 days, whatever, clearly there's something broken here, something going wrong, because it's taking you too long to collect the cash. In my experience, if you leave debt for too long, it tends to evaporate and doesn't get paid at all if you're not very careful. So watch out for that. What we find, and I'm not sure about you guys, but sometimes it's the big companies are the worst ones at this, not mentioning any names. The big corporates tend to insist on, I've got people on 90 and 120-day terms. It's ridiculous. I don't deal with people over 90 days. It's insane. It's crazy. But the big companies tend to, screw the little guys sometimes. So watch out for that. The way around it is be really clear on your terms and conditions of trading. That's where you have your terms on your invoice, but on your agreements, on your contracts, on your offers, make sure it's in there what your payment terms are, so that if you go over that, if they don't pay you, then you can go and charge them interest or go down the debt collection route. You need to notify people and let them know, if you don't pay us on 30 days, this is what's going to happen. Be clear with them, not in a threatening way, but you're not a bank. Don't lend them money. This is a key acid indicator for flexibility in your business, because this is where if your debtors are creeping up, you can't make payroll. Even if you're profitable in your business, because we're not talking about cash, you can't pay yourself because there's no cash in the bank. You're still got to pay tax, of course. So you pay the tax, then when you go down to dividends, there's no cash left. Even if you're going to accrue the dividends, if you haven't got cash in the bank, you can't pay yourself. So debtors is a real acid test. I'd have this as a KPI for, certainly my accounting team have this as a KPI for us. We have a debt collection team. We have a guy with a big dog we send around to chase the debt if we need to, but we monitor it. Very rarely do we have any bad debts. We only work with nice people like you guys do, I'm sure. So we don't very rarely crosses. But there are certain industries out there where people they struggle to collect money. Transport is one of them. Manufacturing is another one where people tend to drag out money, and the bigger the company, the worse it can be sometimes. Not all big companies, but some can be difficult and awkward, so watch out for that. So I would measure this on a regular basis, certainly monthly. So when I get my management accounts, I want these other ratios, all the other ratios we've gone through, conversion rate at the top and everything else as well. I want to know my account and these numbers. Debtor days is a key one. You've also got creditor days as well. How quick are you paying your suppliers? Now, the rule we have, just out of interest, is if we receive an invoice from somebody, even if it's got 30-day terms on it, we pay it anyway. We just pay it, get it done, unless it's a big one or whatever, it's a huge one. But I don't want to owe people money. This is one of those, I don't want to owe people money. I want to pay people. I want cash to flow through business and industry. I don't want to be holding on to cash. We receive an invoice, and providing it's approved, we stamp it, we sign it, and we pay it within typically 48 hours. And what happens then is most of our clients, they do the same thing for us. That's all okay. We still measure the days just to make sure, and it's an interesting KPI. So is everybody on the workshop here, are you measuring your debtor days? Is a measure that you have, or is it something you'd like to have? Who's measuring this? Who's measuring debtor days? Just type in a quick yes or no or something, just to make sure you guys are awake. Who's measuring debtor days as they go through? Yes, or maybe not. Not really. Okay, thank you for your honesty. Yeah, it's one of those things. It's an easy one. What you'll find is, and again, generally, we look at debtor days, is you raise an invoice. One of the disciplines of, make sure you raise an invoice for everything sounds obvious, but there are gaps there. But I can also almost guarantee, even if you're raising invoices, you can have some that aren't paid, that slip through the net. So if you're not measuring your debtor days and measuring it, looking at it on a regular basis on your sales ledger, there's going to be invoices that just drift out and don't get paid. And I've seen this happen. And this happened with an accountant firm in the UK. They're not working with us now. We did a quick project for them. And what they'd done, they were putting through a price increase for all their clients, but they hadn't told them. So they didn't put the prices up. And of course, after a couple of years of not invoicing, they had to go back and try and get a price rise from like 2 or 3 years ago. Well, of course, who's going to do that? Nobody. They lost. My recommendation to them was, don't bother, because you're just going to upset all your clients. And they chose to ignore that advice, and they invoiced all these people, lost all the clients. But anyway, so if you measure it, you may have some invoices there that aren't getting paid, and they should be paid. An unpaid invoice goes straight off your profit, straight off the profit. But it's worse than that, because if you don't know it hasn't been paid, it sits there on your sales ledger, and you're going to pay tax on it as well, because you're on accrual accounting. So really do a bit of housekeeping around your sales ledger and your purchase ledger as well. And the other thing to watch out for, just out of interest, I don't know if you guys have had this happen to you at all, but there are quite a few scammers out there that will just send you an invoice, for 50 euros for something like this. And if you send an invoice of 50 euros to some of the bigger organizations, apparently, I'm not recommending you try this at all, but it goes into like a filter, little invoice might just get paid, and they're onto it now. But yeah, be careful. People might just invoice your stuff as well. Okay, so this is only measured days, but sometimes it's hard to decide on. Yeah. Yes. Okay. Again, I think what something to look at. We do it by currency. We split out because we invoice in dollars, euros, sterling, and other currencies, and the different sectors, different areas. So we would split out our invoices and collections because there are different types of business we're dealing with as well. So you can do a number of different ones for debtor days. So it's a good point. Yeah, there's no rules exactly. Yes, just be nice. There's rules. I remember when I was running a transport company down in Bristol when I was a young manager, and my job was to go and do this troubleshooting, moving around this group of companies, and found there's a big debt. So being a young manager, it was about 8 months overdue or something like that. It's about 25,000. And we had a standard letter we sent out to people, and the letter basically said, overdue debt. If it's not paid within 7 days or indication of it or whatever, we're going to start legal proceedings. And the letter came back, or the fax came back then. And this guy said, look, he said, tell what we do. He said, every month we get all the invoice that we owe to people. We put them in a big bucket in the office, and we draw out the number of invoices until we've got, for all the cash we've got, we draw out invoices until we've got rid of all our cash. He said, and that's it. So if we don't pay you now, he says, because we haven't got the cash, you'll be in the bucket next time round. And he said, if you keep sending letters, we're not even going to put you in the bucket. And he was like, oh, right, okay. So my learning from that was, if you're going to chase money, pick up the phone, don't threaten, but go down. If you have to go down the legal route, then so be it. But pick up the phone, have a chat, sort it out, do a deal. And 9 times out of 10, you can find a way through, because other people tend to threaten with lawyers and, people with baseball bats and dogs, that sort of thing. We don't want to do that. It's expensive. I've always normally found if it's an overdue debt somewhere or something, normally they I haven't received your invoice. Okay, we'll resend it and let me know. And you're in dialogue. Most of the time that's sorted out. So debt's an interesting one, but yeah, it's a good point. There's not a lot of rules there, but just play nice. It is your money. You're not a bank, and you want to collect the cash in so you can pay your people and pay yourselves as well. So measure debtor days. Same rules apply with creditor days. Same sort of formula, and you can work out, are you paying people too quickly? Arguably, we pay people too quickly. But the reason I do that, and just out of interest, is what I found is I want to have very good, not just good reputation, but credibility with our suppliers. We're not a very big organization, not a big company, and I don't want to have anybody able to say, oh, these guys must be in trouble, then they're not paying us on time. So where possible, I pay people on time or early, and it is good for our reputation. I know people hopefully say nice things about us because we pay on time, and when that happens, is if we need a favor from anybody or whatever, they're much more likely to work with us. Something else we used to do on invoicing, and again, not particular ratio here, but when we were based in the UK, and we do it occasionally now as well, is when we send an invoice out, we were sending invoices out in the mail, in the post back then, not email as they are now. We would send a chocolate bar out with every invoice. So in the envelope would be the invoice and a thank you card. Thank you for doing business with us. Please find and close your invoice. Here's a chocolate bar. And that went down really well with the accounts teams, the clients. In fact, they used to then request specific, can I have dark chocolate or fruit chocolate or this sort of thing. And my son Richard was he called the director of chocolate. He'd go out each week and buy the chocolate for people, but he built a very nice relationship with people, and we never got anybody paid us late. They all paid us on time or early because we had that sort of fun relationship with them. What we also did, as a tip as well, is when people pay the invoice for you, thank them for it. they're obliged to pay, but when they pay you, hey, that was great, thanks for that, and so send another bar of chocolate or something like that, because if you're not very careful, the last correspondence they get from us is the invoice. Well, that's great, but thank them. Yeah, thanks for paying, it's really appreciated, thanks very much, and away we go. They're obliged to pay it, but why not be thankful for it? That might help you, get your days down in terms of the money that's owed to you as well. So anyway, a couple of tips from the dark side. Okay, what I also do, because we're on to cash now appearing on the balance sheets, is I always check my daily cash in bank, daily bank reconciliation. We do it in the morning because we have banks in France, Luxembourg, and the UK. Sounds very grand. It's not that grand. It's not as fancy as it sounds, but we have to trade through France, Luxembourg, and the UK. And we do a quick balance. So what do we expect there to be in the account? Who's paid? Who's not? And we do a daily bank balance. It's like a bit of a comfort thing, really, but we know what should be in the bank. And we know what was going to go out, and I want to know that things are happening, things are flowing through. So just check, it's worth it. Just check on your daily bank balance. If your bank won't, you can give it to an online banking, this sort of thing. For one of them, you have to go to an ATM and check. They haven't got online banking in one of the jurisdictions, but anyway. But just do a quick check. Cash in the bank is like a comfort thing, and then that you're sort of okay. Compare it with what you predicted to be in the bank on your cash flow forecast, and see how good you are at predicting your cash flow. It's never perfect. I guarantee it's never going to be perfect, but how are you doing with your cash flow forecasting? Because what cash flow actually predicts is a net figure that will be basically your bank balance. So what's going to happen in your bank, they're going to sort of, when you authorize a payment, it may take a couple of days to go out. I don't know if are you using checks? Anybody using checks still? No, good. I mean, bizarre. I was asked to write a check the other day. So I haven't written a check for years. It's like ancient technology. But anyway, but the BACS payments, electronic payments, take a couple of days to clear and all this sort of thing. So you can gauge it on your cash flow forecast. But I recommend daily cash reconciliation. What's in the bank? Are we okay? And if it's wrong, have a look. We were taken for fraud once in the UK, where the bank were making payments out to another account. And it was their fault. They got it wrong. They'd miscoded it. Wasn't authorized by us. The only reason we pick it up, they didn't pick it up because they didn't care basically. But we picked it up because our cash flow forecast and our bank balance, they were out, consistently out for about 10 days, was wrong. So we phoned them, went through it, and they gave us the money back. But then, because their banks aren't perfect, they're not. I wish they were, but they're not. So daily cash in bank. And then we've got stock. Now I put a question mark here on stock, because it depends what business you're in. If you're an accountant, for example, accountants have something called work in progress stock. They do work for a client. They haven't invoiced it yet. It's a tax investigation. They've done £500 worth of work. They haven't invoiced it, so it becomes work in progress stock. WIP, they call it WIP stock. You may have stock on a shelf somewhere, inventory or whatever it is, but measure your stock. Make sure you get control of it. Who's got stock in their company? Anybody got stock? Finished goods stock, work in progress stock, anything like that, or not so much? It doesn't matter. Anybody? No. Yeah. Okay. Yeah. Good bit. Okay. Great. Again, you probably know this, but my experience, I watch stock. We don't have stock in our company. We don't have it, but certain clients they do. Accountants are classic for this. They have high work in progress. Watch out for stock increasing. If you find work in progress, WIP stock increasing in the business, there's something not quite right, probably somewhere. And what I found is if it increases over time, then when you come to invoice it and it goes out of stock into invoice, into sales ledger, the client doesn't like it. There's a surprise and a shock. Stock evaporates, it goes rotten on the shelf. Even if it's work in progress, be really careful with it. Have a limit. With both accounting practices that we're working with, we have an agreed limit of work in progress. If it goes over that limit for any reason, they've got to justify it. Not just to me, I'm the coach, but they've got to justify it and remember it and go through it and find out where it is. If it's justified, it's fine. But if it goes over, and it's something like about 10% of sales is their limit on work in progress. So one of the accountants from a long time ago, they had a huge amount of work in progress, and you can never invoice it all because it's like 2 or 3 years old. It's crazy. It's out of date. You can't invoice it. So watch out for stock. If you've got a warehouse, Quick tip on warehousing. If you've got a warehouse, not sure we've got any distributors here or warehousing people, but my background is logistics as well. If you want to check on, do a very quick stock check, a little trick you can do is print off from your stock control system. It's called an empty location report. So you go into your warehouse and the computer will tell you what it thinks are empty locations where there's no stock or no pallets. And all you do is walk around and you find, now if there's an empty location and it is empty, that's great. If there's a location that it isn't on the report but is empty, it's wrong. And also if there's a location where there is something and there shouldn't be, that's also wrong. Just count the errors, number of missing pallets, whatever it's going to be that shouldn't be there, gives you a percentage, and you can go back and say, my stock's out by 5-6%, and you can have a quick walk around. I'm going to do a stock take, just walk around and have a look. It's an easy one for that. Watch out for, it's called stock shrinkage. If you've got products on the shelves, if you're in retail, or you've got stock of products or computers and this sort of thing, watch out for people nicking stock. It sounds horrible, sounds harsh, but a valuable and attractive stock will disappear. It'll go out the back door and end up on the sort of car boot sale, maybe from time to time. Really control your stock because it depreciates in value when it's on a shelf. You can't invoice it for the full value when you sort of go through it, and it might get stolen. It's a physical stock. It might get stolen. We had this. I used to run. Anybody here remember Commodore computers? Remember Commodore computers? Yeah, you do. Wow, you're older than you look. Wow. Anyway, in a good way. But Commodore computers, the Amiga and the C64, and that was back in the day when we had software was on. It was on cassettes actually. Then we had it on CD, and we were losing software, and we couldn't figure out why. It was all on stock, all accounted for. We were losing software, and what was happening was some of the lads in the warehouse were coming in back in the day. This was remember the Sony Walkman, the headset thing with the cassette. They'd walk in with a Sony Walkman music player on without a cassette in it, and they'd walk out with a cassette in it, and it was spinning so you could see it, but of course it was just code, it wasn't music. So they were coming in every day and taking a cassette home every night, and we rumbled it in the end. We found them, and we fired them and got rid of them. So watch out for stock. It tends to not be the value that you think it's going to be because it just evaporates. So watch out for certainly WIP, work in progress. Yeah, avoid it if you can, in my experience. If you've got stock, measure it, have it as a key indicator, but be really careful about it. Okay, any questions at all? We're going into the home run now. There's another about sort of 15 minutes of me, then we got some questions at the end and wrap up and review, some more assets to go from, more ratios to go for. But any questions so far? Anything you'd like me to repeat, explain, go over again, or is everybody happy? No, everybody happy? This is good. Oh, I wanted to touch back on the budget topic versus. Okay, yes. Okay, great. Yes, good. So budgets and projections. So yeah, what can you be? Would you like to unmute, Imrich? Please unmute and talk. Everybody's thinking the same question, I guarantee it. And I can probably, hopefully answer a bit quicker for you. So just if you'd like to unmute yourself and jump on, if that's okay. Yeah, I can, I think you're unmuted now. So when you're ready. Oh, I'm not sure. I don't hear. Imrich, I don't hear you. I'm not sure if you're able to.
Well,
or the audio is very weak. Maybe just maybe type it in if you could. I'm not getting the audio. That's all. Sorry, I'm not getting the audio very clearly. Just maybe just type it in, but give me a couple of pointers, and I'll happily jump back onto it for you. So I'll give you a bit of time just to type it in. Anything like me, my typing is not great. So here we go. So yeah, just type it in, and I'll come to it when I see it. Okay, all right. So now we're moving into stock. Now we're moving into, these are ratios. Now, in any company, or any business, ratios are a great way of measuring performance. You know, gross margin is a ratio, net profitability is a ratio, efficiency, it's a ratio, it's the levers of power and control. And these are really things on the balance sheet. I mean, look at your balance sheet for your business, and this is a sort of a financial statement. Remember, the balance sheet is just a photograph. It's a picture of your business at a moment in time. The moment you publish your balance sheet, it will change because some cash may go into your account or go out of your account, or an invoice has been raised, or whatever it is, it changes. So it's just a snapshot of a moment in time. But think from a business owner perspective, there are 2 or 3 ratios that are, well, obviously more important than others to a certain extent. The first one is current ratio. Your current assets divided by your current liabilities. So recognized accounting term, sounds very complex. It's really not. First of all, a current asset is an asset that you can release or get your hands on within 12 months. So cash in the bank, it could be a machine, it could be something you can sell, whatever it is. It's something, not a long-term asset. Maybe you've got long-term assets, could be an investment somewhere, for example, but you can't get it for the 12 months. That's a long-term asset. I'm not interested in that. Short-term assets divided by your current liabilities. Current liabilities are things you've got to pay within the next 12 months. So it could be short-term loans, it could include salaries, it could include suppliers, whatever it is, short-term loans. This is a measure really of how are you able to pay people? Are you able to fund your business in the short term? Are you liquid? Have you got cash in the business, if you like? So current ratio. So 100,000 of current assets, 80,000 of current liabilities, 1.25 is your current ratio. It wants to be more than 1, basically. You've got to be more than 1. If you can get to a 1.5 or 2, then great. Depends on the business sector, but I measure this on a regular basis. Okay, so here we go. Questions just coming in, so I'm going to divert back to this question. If that's okay. But if you need to go into more detail, just do a weekly, monthly breakdown. Yes. Okay, so yeah, what I would do, that budget template, just answering the question, it's a great question, is on monthly. So I'm looking at monthly sales and monthly expenditure. That suits my business. It may suit other ones, it may not. Yes, will I go into more detail? Yeah, absolutely. What you can extend out either more lines of things you're going to be interested in, or you can do it weekly. Maybe you've got a weekly budget. You want to go into much more detail and drill down to it. Only go down to the detail that is appropriate for your business. But yeah, more detail, the better to a certain extent. Do I suggest accrual or cash? I prefer accrual. And the reason I prefer accrual approach is because it gives me an image of the activity of the business, and that's what I'm really interested in. I want to measure my cash, which is separate, but accrual, what it means is that I'm going to raise an invoice, take the sale, pay somebody, or get an invoice in from somebody and take the costs. So it's an immediate, much more visible. It gives me more of a real performance of the business, because if I'm waiting for cash to come in or waiting for invoices to come in, I'm not really matching behavior with results. Whereas on accrual accounting, it tends to be more aligned with, I've done the work, raise an invoice, get the sale. If I'm waiting for the cash to come in 3 months' time, well, I'm missing I'm not matching it with my behavior. So I prefer accrual accounting only because it tends to align activity with performance. Both are valid. It certainly depends on your jurisdiction. I think in the UK, we can choose cash accounting up to a certain level, and then we have to use accrual accounting as the standard format. I don't know about your particular jurisdictions. From a planning point of view, budgeting, and to an accounting point of view, I prefer accrual. It's just what I'm used to. It's not compulsory, but I tend to go down the accrual route and not the cash route. So hope that helps anyway. So yeah, but more detail, and I prefer accrual is the key. So now current ratio, sorry, back to this one. This is a key driver of your ability. Now, when you publish your accounts, if you're submitting your accounts and suppliers want to look at you, or they are going to lend you money, are they going to, how are you doing? They'll work this out. They can maybe get hold of your balance sheet if you're publishing it, and say, well, how good are you? Are you generating assets? You're holding on to them? Are you generating cash? Are you a successful business? And the current ratio is an interesting interesting way of looking at it. Plus, you can compare it with other companies. You can look at the current ratio for big corporations, for example. They have to publish their accounts, and how you're doing compared to Microsoft or Apple or wherever it is, and you can sort of benchmark against it as well. Nice, easy ratio. It's something to watch out for, because if your current ratio starts to drop, it may mean that your assets are falling away. Maybe you haven't got as much cash as you thought, you haven't got, whatever it is, it's beginning to run down a little bit. So you can set this as a key performance indicator in the business as well, and current liabilities. Now, you can sort of jack up your current liabilities by, not paying people, for example. As current liability, just not paying people. It's not great, but you can massage it in all sorts of ways. But as a ratio, choose a number you want to go for, speak to your accountant, maybe look at the industry sector, choose a figure you're happy with, a figure that serves you and suits the business, and then measure it on a monthly, maybe quarterly basis as well. So current ratio is a key one. Then we've got working capital. This is sort of the cash available in your business. So it's just your current assets, what you can get your hands on in the next 12 months, minus what you've got to spend in the next 12 months. So that would be 100,000 of current assets, current liabilities. You've got 20 grand to play with, 20,000 to play with. And this comes down to when you maybe want to buy a new computer system, we invest in something or expand something, whatever it is. This gives you an indication of the performance of the business. Have you got the money to spend? Can you invest? Do you need to look for outside funding? Because, maybe if you want to invest in new equipment, or you want to invest in new systems, whatever it is, you haven't got the working capital, haven't got the cash for it, the working capital, you got to go out to the market and get it. I do have one client who's currently doing a crowdfunding, because we looked at it, he hasn't got the working capital in the business, he's crowdfunding an opportunity. Well, great, that's one way of doing it. Other people can go to the bank, or they may call on your shareholders. Now, if you're the shareholder, of course, it just means you've got to put money into your own business, which is fine. That's it's okay. It depends on your own personal situation, but working capital is the ability of the business to fund itself and invest in things that are going to drive it forward. This is not on your P&L, not your profit and loss. Profit and loss doesn't reflect all your balance sheet ratio. This is why the balance sheet is so important. And there's probably, I would guess, 50 ratios. If you Google, balance sheet ratios, you'll see pages and pages of this thing. I've just chosen 2 or 3 top ones that are good to look at. There's all sorts of other ones you can look at as well. And the key with the balance sheet is to choose the ones that serve you, choose the ratios that serve you, that make sense for your business. And those are the ones you can monitor and measure as you go along. So working capital, and the final one then is equity. Now, as a business owner, I'm interested in equity. I want equity, because if it's equity is where it's the valuation of the business. It's my worth as a business owner is the equity in the business. So this is total assets now, all the assets of the business, whatever you own, short-term and long-term assets, minus your total liability, everything that is owed to you. Interesting point is that profitability on the balance sheet is a liability, or retained profit is a liability, because it's a profit is something that can be withdrawn or taken out by shareholders. So profit is not an asset. Profit is a liability in your business, because it's something that can be drawn out by shareholders. Might be you, but other shareholders can do the same sort of thing. It's owed to other people, basically. So we'd be slightly careful on that one. I was surprised by that. So total assets, 250,000, minus total liabilities, 150,000. Owners' equity, 100,000. And as owners, that's really what we're interested in. We're interested in what equity and valuation are we building for ourselves, for our families, and succession planning, all this sort of thing. Are we building value? Are we building wealth as well as we go along? So those are the 26 numbers, the 26 ratios and things I suggest and recommend you have a look at. The reason for it is, I think with those 26, I chose them because you may not need all of them, but if you can choose the appropriate ones or methodologies for you, I think it'll give you control, it'll give you visibility, and it'll give you planning ability for your business. some of them are accounting based, some of them are balance sheet based or cash, some of them are just commercial ratios. But I hope that will give you some control and visibility of your business. That's why I chose them. So there we go. That's the final one, is equity. And I say this time up towards the end, then for questions and discussion. So I'm here to answer any questions you may have. That's the end of the sort of content. Is there anything else you'd like me to explain or go through or go into more detail? Please fire away and I'll do my very best. So over to you. Any questions I can answer you with, you can type them in. We can have a discussion or we can just pick on people individually. So any questions, please fire away. I'm here for you now. I'm yours. I'm all yours. I'm captive. I don't know, but Sarah, any questions from you? I guess if you're anything just jumped to mind.
No, not at this point. Thank you.
Okay.
I have a question.
Excellent. Good.
It's actually a question directly from practice.
Mm-hmm.
So what we faced, for example, now that we were discussing equity and not equity before that, ratios. So for example, like you said, when you crowdfund it or you sharehold it, doesn't matter.
Yeah.
So for example, the problem that we were facing the most up to this year probably is how to tackle when company starts to grow too fast in regards to initial investment. So to be very clear, what happened to us, company went from, I don't know, 300,000 euro of turnover, jumped in next year to 4 million, in next year to 9 million, and
Wow.
And of course, the company was established with 25,000 bucks. So you can imagine, and I never had to put any money again into it.
Of course,
every year we have profit, but because our debtors have opened together, I don't know, maybe 500, 600 clients, almost up to 1 million euros per month of this debting. So you can imagine, I never saw the profit except in the balance books.
Absolutely, exactly. Yeah.
Because you cannot take out something if you are crediting your other business with it and the development. So I have a question, if you have any smart advice how to overcome this, because otherwise we will be working for next 15 years with this growth and it can do even 500 million in 1 year. I will still not be able to cash out anything.
Wow. But this is a classic story. I mean, congratulations for the growth. I mean, good job. That's significant growth. I think that the tale of the story of lots of fast growth businesses, they suck cash out. They just do, because everything goes up and their debtors go up faster and this sort of things. It's a very common situation. I think the thing is, there's probably 2 or 3 things would spring to mind. Either maybe at some point you may slow the growth down a little bit. I don't know, maybe you'll slow down the growth. At that point, when growth slows, then cash will improve, but naturally cash will improve because you're getting into a trading cycle. So maybe, I mean, is the growth still going up as fast as it was?
Well, actually during last year, it went basically, we opened this company in 2017, so it went 300k, 4 million, 9 million, 13 million.
Okay,
so
it's going mad. Okay, you're not going to slow that down, so that's going to continue. So basically you've got to fund they've got to fund the cash flow for it. Ways around that: first of all, if you've got invoices out in the field, and I'm not recommending these, by the way, these things that I've done. We had the same thing with our company back in the UK, and we factored invoice discounting, factored our invoices. So what that is, we took our invoices to the bank and said, look, we've got an invoice here for whatever it is, and the bank gives us some money. Again, they give us 80% immediately, and then the bank gets some money from the client, and then we sort of we flip it out as we go along. So invoice discounting could be an option, because then the bank is funding your sales ledger for you. The downside of that, of course, is that, and what we found the downside of it is, once you get into it, very difficult to get out, because if you're continuing to grow all the time, you're never going to catch up. You're always indebted to the bank. And what we found with the bank was, they would say, for example, if a client didn't pay them on time, they reduced our ability to draw down. So at some point we were no better off, because the bank didn't pay us and the client wouldn't pay us either. So it's a way of doing it. It is a way of doing it. to sort of free up the cash. You can do 2 or 3 different types of invoice discounting. It can be expensive. You've got to pay a percentage on your sales as well, because the bank want to make some money out of it, but it does release the cash. With the way we did it, we didn't. Some banks want all of your sales ledger, or just part of it. We went down just the partial route. We only had to factor or invoice discount some of our bigger clients. That worked out well for us. But I think even the point we sold the business in the end, we never got out of it. We never traded out, because we were growing fast like you were doing, which was great, but we never tasted it because we never got the blooming cash. You could never go and feel safe and secure because the cash, good on balance sheet, was great. The balance sheet was fabulous, but we couldn't actually fund the business all the time. So factoring is one way of doing it. You can look to go to the bank for a loan. You can, if you go to a bank, or now we looked at high street sort of business banks. The best response we got was actually from private banks. We got private investors and this sort of thing. They're much more commercially. I assume they're still going. Now we use Close Brothers. We're a private investment bank. And we said to them, look, we've got these invoices from some very big customers, blue chip clients. Will you fund overdraft? Basically, will you fund overdraft for us on the basis of these coming through? And that we did that with another one of the divisions as well. So you may get some bank sort of funding coming through. Again, you're going to have to pay for it, because you've got to pay the overdraft fees and the loan fees, this sort of thing. The other way around it may be, it depends on your view, is get some other investors to come in. The challenge with that, of course, is you may be going to have to give up some equity, some stock for the benefit, and they're going to put cash in, but they're going to want the dividend and that sort of thing out of it as well.
No, this does not come into consideration.
Yeah, good. I wouldn't recommend. I wouldn't get on that route. Keep your shares.
Already also 4 owners, because we were all roommates at university.
Oh right, okay. Well, there you go. Okay, good.
Yeah.
Don't do it. I would.
Okay, good. Thank you for this factoring. It's good idea. I already heard about it, so yeah. I will of course look into it. Thank you very much.
My pleasure. Have a look at it again. With everything like this, take professional advice. I'm not an accountant. Speak to the bank, get the best options. With factoring, just if you get into it, make sure you can get out of it. We never did, and we sold it in the end. But anyway, but a couple of ideas for you.
A little bit of factoring, to be honest. But the thing was, for example, we are in this small country of Slovenia, right?
Yeah.
Here, and we run logistics business, because we are sitting in the port.
Yeah.
And we are working with 120 countries, and the problem is now that our national bank doesn't even want to hear about factoring some from someone in China or United States or whatever.
Right. So, okay.
But I think this low interest loan at private banking, this is the idea I wrote down as probably most viable. So
absolutely try it. And genuinely, the reason for private banking might be an idea is because interest rates are low at the moment and people can't make money in traditional ways. So they're looking at alternative investments, wine, whiskey, cars, all this sort of thing. A lot of the big investment funds are going down that route. It may be there are some people, and I don't know, within the private sector or private banking that are making no money on their on account, and they're willing to take a punt on a private business with big opportunities. So it could be an option. I mean, tread real careful, tread real careful with it, but it might be worth a conversation. That was all.
Thank you.
My pleasure. Okay, well, great question. Excellent. Okay, good. So we've probably got time for another question. Anybody else got any further questions? Any further questions that anything you throw at me? If I don't know, I'll find out for you. But any questions? Any questions? Okay, I'm going to pick Petar. Can I pick on you just to give you a quick, just not a question, but what did you, any takeaways, key takeaways from the workshop? Just give me a quick overview, Tom. What did you pick up from it? Just give a couple of points, maybe.
Sure. For me, I think I'll need a lot of Googling. I think, yeah, for me, I think there were quite a number of terms that I wasn't really aware of coming in. So yeah, I was actually expecting that one. One of the things that I think that I will feel much more secure going from this is I think I will be more prepared to make mistakes and identify it when I'm making the mistakes. Yeah, that's sort of the biggest takeaway here, because I know that I am going to be making mistakes, but identifying them quickly enough, I think this will help.
That's a great point. Brilliant. Thank you. I think, you know, what it could be, we all make mistakes. And I think a lot of us go through life, we don't realize we've made them. Doesn't mean we're not making them, but we don't realize doing all this sort of measurements, it might hurt a bit more, but at least we know about them, and then we can correct it and learn from it and move forward. And look, I've made plenty of mistakes. I guarantee it. I made that in my career coming through, still do now. You know, there's nothing perfect in this world in terms of numbers and accounting, but yeah, measurement and visibility is probably the key one. So great, good. All right, thank you. Appreciate it.
Thanks.
Okay. Okay. Anything else? You know, I'm here. Any other questions, thoughts, observations that I can help with? If there's not, you know, happily I can. We can pause the recording and we can go and enjoy the awesome sunshine. But any other questions? Anything else I can help you with? I said the sun's a bit dark here now as well. So. Okay. Well, quick question for me. Has that been helpful and useful? Just give me a thumbs up or a nod or a wave or something. Have you found it interesting and useful? And my friends in the embassy in Sofia got some questions to ask your network now.
Well, it was really very interesting. These were our first steps, so we were very, very focused. Especially what interacts a little bit with our obligations here, me as operational manager.
Yeah.
It's especially the time efficiency, productivity.
Yeah.
And I really like the point, and I will just mention this to our manager tomorrow, about the meetings that are the killers of those two concepts. We have very, very long meetings.
Excellent.
But well, we are at the end non-profitable organization, and we
Sure.
are this as representative of the embassies. But who knows? Maybe we can have some future plans. So you never know. But
Absolutely. No. Well, great. Then good. But yeah, these meetings I find meetings to be the biggest killer of productivity. Nobody likes them. Nothing happens as a consequence of them, and yet everybody keeps on going to them all the time. I've never understood it, but anyway, it's just one of those things that. Never mind. Okay, good. Okay, so what we'll do, I'll let me stop recording there for a second. Everybody on the call, thank you for your time. Appreciate it. Sarah, thank you for inviting me to work alongside you guys at your company as well, which is really good. If anybody wants to join me on LinkedIn, but you're more than welcome to. Just David Holland MBA. You'll find me on LinkedIn. Let's connect, and there's all sorts of bits and pieces on there. I hope to see you again on another event that Bisera organizes. So thank you for participating. I've enjoyed it. I hope it was useful. I'll get all the notes across. In the meantime, have a fabulous afternoon, and I look forward to seeing you again soon. But bye for now from me.
Thank you, David. Bye.
My pleasure. Bye-bye.
Thank you, everyone. Bye.
Bye.